It is needing to play catch-up. The outlook as well, coming through from Intel, less positive than the analysts had expected. IAG dropping a deal around Air Europa. They're going to take a approximately 50 million euro hit in terms of the termination fee, but it's a beat in terms of Pirelli with their earnings. So we watch that stock for the upside, Anna.
Absolutely, we'll watch all of that. Interesting to see how much of the tech story around Intel is idiosyncratic to them, but even away from that, there's nervousness around CapEx spending on AI from tech names. So tech in focus for both of those reasons. Let's have a look at where these European equity markets open up, and to the downside is the answer in the initial trade, down 0.1% or so, a couple of tenths of a percent on the FTSE 100, waiting for the other markets to open up. The read across from tech is sometimes a little awkward into the European session, but we'll see where that Intel news takes us, the Amazon story, the Apple story. We'll see whether that nervousness around the spending on AI, how that is expressed this morning. There we are, some real nervousness around the FTSE MIB then, down by nearly 2% on the Italian market this morning. The IBEX down by 0.8%. Yes, it's the tech narrative perhaps, but it's also the broader story around the jobs data out of the United States. Two data points yesterday that really started to coalesce around a pivot, as Mark Cudmore was telling us last hour, a pivot from concerns around inflation to concerns around growth and jobs. And that's very forward-looking, isn't it, Tom? Because we're going to go there later with the non-farm payrolls report. But for the moment, European stocks then following Asia firmly into the red.
Yeah, and you're actually seeing, what you're seeing is a bit of support, it seems, for the FTSE 100. It's down 0.5%. You compare that to the drop in the Italian FTSE MIB, down more than 2%. Some of that support, it seems, coming through for energy in terms of the listings here in the UK, given that oil is still above $80 a barrel. But on the technology story, it seems investors are expecting a clarion call of further growth from these big mega-cap tech stories and tech names. They have not had that. There has been the granularity, the detail, the nuance within those stories, and that is proving harder to navigate, it seems. In terms of your individual sectors, the biggest losses now coming down for the financial sector, losses of more than 2.5%, and a bank's also taking a big hit, down 1.7%, despite the fact we've seen some of the French names, for example, reporting better results, and here in the UK as well. Industrial's also taking a big hit, down 1.5%. Every single sector, including the safe havens, or at least those that you may move into in a risk-off environment like utilities and healthcare, also down in the red now. Every single sector in negative territory in the first 2 minutes of this trading session.
Yeah, financial services is one of the worst performing, thinking about where nervousness around jobs goes, how quickly we get rate cuts. Maybe that's some of the thinking there. But interesting to see that UBS is one of the biggest movers to the downside this morning. So we're down by nearly 6%, the most in 16 months on that one. So we'll certainly keep an eye on there. On the upside, though, there are some financial names that are moving higher. I think I spotted AXA to the upside a moment ago. And of course, we have had talk around, we have had that story around what they're doing with BNP Paribas to buy AXA's money manager in a 5.1 billion euro deal. That's what we were reporting yesterday and into this morning. So certainly this is a sector in focus, and we'll get more on that sector as we go through this morning's programme.
IAG, and we've been talking about that, the fact that they scrapped their bid for Air Europa, being welcomed so far by these markets. You're seeing a gain there of a little over 3%. And then we've been talking about the semiconductor read across from the softness in terms of the outlook coming through from Intel, and a really challenging set of results from that company stateside. BE Semiconductor falling more than 6%. So there's the read across there as well. In terms of some of the industrial companies, ABB also taking a big hit. Of course, the industrials in terms of robot making and other components within that business. That company down 4.5%. Logitech as well within the tech component down 4.4%. So there's a hit there in terms of the financials, in terms of tech. And again, as we said, so far, every single sector in negative territory. And the FTSE 100 just down 0.4%, losing 37 points, but bigger losses coming through in Italy and Spain.
Let's get some perspective on these market moves then this morning, this negativity across stocks. Let's bring in Jeffrey Yu, a senior EMEA market strategist at BNY Mellon, for his thoughts on what we are witnessing right now. I mean, negativity around stocks, just down 0.4% on the FTSE 100, but there's more pain elsewhere, and certainly banks, financial services and industrial goods and services seem to be the worst affected. Jeffrey, good morning.
Morning.
What do you make of this sell-off and the multiple drivers of it?
So I think the employment situation, the recession word, the R word, that certainly is coming through. We think that maybe this is slightly overdone for the time being, but again, it's all in the data. Every single central bank has said that they will take every single meeting at a time. If the data confirms their fears, their downside risks, then they will act as needed. But I think it's just the CapEx spending, as you mentioned earlier, and quite a few earnings reports have highlighted that consumer really is feeling the pinch right now. Look at UK, for example, in the savings rates, we're back in double digits. That is almost unheard of if we strip out the pandemic era moves. And that is happening despite good wage growth. In the US and the UK, those supposedly high-spending economies. So clearly households are cautious. That means corporates need to be cautious and markets are now reacting accordingly. OK, so we have cautious consumers, concern around CapEx spend at tech names. And what about these cracks in the labour market in the United States? It does seem as if it was a week where we pivoted, as our colleague Mark was saying earlier on, from being worried about inflation to being worried about jobs. I wonder, I feel like I've said that a few times, though, as if we've had a few false flags on that front. So what do we make of this data? So firstly, on the manufacturing side of things, right, UK ultimately is the US is ultimately a services-driven economy. So that's where let's take things with a pinch of salt. And people have mentioned, public sector employment, that's still driving things as well. So we need to look at things on a holistic basis, which I'm sure that the Fed will be looking at as well. But are we going to run into a situation a bit like what's in Europe? I think the ECB is actually not acting fast enough because their manufacturing sector, the Eurozone manufacturing sector, has been contracting for God knows how long now, that they're still saying, no, services inflation is high, service inflation high. But here's the difference. The Fed has a dual mandate. The Fed has an employment mandate as well. The ECB does not have that, so the Fed will be much more attuned to this.
And the irony within the ECB is that they're getting pressure, of course, from the Bundesbank saying, hold on, let's not forget about these inflation risks. And it's the German economy, of course, that's taking the biggest hit in terms of manufacturing. Is the Fed behind the curve? Is that now where you land when it comes to this Federal Reserve?
I don't think there's enough data to confirm that yet. But the Fed, I think they will be able to look at the labour market situation with respect to earnings. So I think if earnings today runs at 0.3% sequential, 0.4% sequential, for example, how do they square that circle? If they need to focus more on their employment mandate and then pivot accordingly as well, right, then they can sort of catch up to some extent. But I think they need another, say, 2 or 3 more inflation labour market prints to confirm that. Whereas for the Bank of England, for example, which doesn't have good labour market data, full stop, right? They've acknowledged that outright. I think they don't want to be behind the curve, so they're moving early because they don't want to find out that actually the labour market's in a much worse state when they get the data.
Can we linger maybe on some of the tech nervousness then? Because I mentioned earlier, the read across from US tech into Europe is sometimes a little awkward. It does not seem awkward this morning. It seems quite obvious. So we have ASM International shares falling as much as 11%, BE Semiconductor dropping 7% out of the gates this morning. ASML shares halted in Amsterdam, this giant of the tech world halted. What read across should we take from Intel, for example? Is that quite an idiosyncratic Intel story about them being behind the curve on AI, or does this tell us something broader?
I think the broader issue is profitability going to be as strong as the perfection, so to speak, and that was expected at certain points over the last year. Now, this is a sector, which for a point markets had thought that demand would not be price sensitive at all. So that's where we always tread into somewhat dangerous territory. If you think something's just going to go parabolic forever, it doesn't. There's always gravity to come into play. And I think companies, they are just not seeing, as the ISM, again, the new orders side of things, as a broader reflection of where CapEx is. So if that investment is not going to be there because final demand is not going to be there, I think that adjustment is taking place accordingly. There's always going to be hiccups along what is going to be a growth story. I'm fully on board with that, but we just can't be priced for perfection as we were perhaps a few months ago.
So I wonder how we think about carving out different names within tech then, because one of the key concerns for investors clearly has been how much money Meta and Microsoft and Amazon are spending, and they've all recommitted in these earnings to continue to spend into 2025, most of them at higher rates from the capex that we're seeing right now on a quarterly basis around AI infrastructure. So the beneficiaries clearly remain NVIDIA and to some extent AMD as well. So I wonder, the volatility in NVIDIA this week has been pronounced. You don't have to give us names, Jeffrey, but in terms of how you want to be positioned across the tech space then, given some of the downstream and upstream parts of this story.
So I think you want to move along the growth curve there. So you mentioned infrastructure, for example. That I still think is going to be medium to longer term story. You want the infrastructure to be in place when the cycle turns towards the upside again. So I think, that's where some adjustment needs to take, however, on a discretionary basis, because right now, going back to wage growth, going back to consumer, if discretionary spending, that is going to be a bit softer, especially on the services element. I think that's where in the tech space and the communication services space, we could struggle a bit. But the long-term growth element, this arms race almost for chips, for superiority, for investment. If you look at what China is doing right now, they're still, trying to move forward with this high-quality growth as much as possible. And in some sense, I wonder, are Western companies a bit worried about that crowding out of that space? They're going to face competition as well, so that's going to impact margins too. So even though demand is strong, don't assume that you have a natural monopoly over things. So I believe in the infrastructure story, but right now anything discretionary, especially on the consumer side, that's going to soften a bit.
And thinking about the tech infrastructure story, do you think investors will continue to have patience, to Tom's point, have patience for businesses that want to spend through the cycle? So if we enter a sort of cyclical weak spot, but there's still the structural story there to invest in data centers, invest in AI, will that continue to have momentum despite cyclical weakness?
I don't think, so from investors' point of view, they don't want to see the no-holds-barred growth, the spending that I think had sort of been priced in the past. But at the same time, they don't want to see just a sudden swerve, a turnaround in expectations either, because this is going to be the future, and this is going to be a strategic element. Let's not forget that, especially with geopolitics driving things right now. There's going to be government impetus with governments at the end of the day. They are big investors in this as well. They don't want to see innovation fall behind. So I think that's where private public sector funding will be in place, especially in the West. They want to be left out. But right now, for areas where perhaps spending can be pulled back and some discipline in particular with regard to costs, that needs to come through. But I think that's something the market will exert.
So on the hardware story, if you've been desperate to get into some of these big names in the last few months, is this a buy the opportunity in terms of this dip?
Well, if you look at the ISM numbers right now, if we have another, let's say, few prints around 45 or so, then that's something a bit more structural, right?
Okay.
So in the shorter term. So I think we need 2 or 3 more prints to actually confirm things. Yeah.
What about the rates trajectory from here then, Jeffrey? We've talked about some of the cracks maybe in the data story out of the US and the extent we should dwell on them or not. Where do you sit then on where the Fed goes on rates, or what kind of frequency of rate cuts we're going to get from here?
25 beeps per quarter right now, I think, is the standard for the Fed, for the BOE, even the ECB, though I think the ECB does need to do more, maybe some conservative cuts, coming through. Still hanging on to my euro lower trade, much lower trade in that respect, but from their point of view, they still need to look at their inflation mandate as well. So I think the Fed will be really worried about stagflation at this point, whereby if you have, let's say, a payrolls print at around 150,000 or so or lower, but then earnings prints like a 4% annualized handle, that's going to be quite a struggle. It's like the BOE right now. They are seeing services inflation still close to 6. If you look at the annualized print of the last 5 monthly services prints, we're running at close to high single digits, low double digits at this point in the UK, services inflation.
Yeah.
So that signals a growth story, but not necessarily a broader jobs story.
But the Fed has a dual mandate,
Exactly.
unlike the Bank of England,
Yeah.
doesn't it? So maybe we get more emphasis on the weakness in labour there.
Right, but productivity is higher in the US, and that's where the US is always can be counted on to resolve that stagflation issue for itself. But in Europe and the UK, I think that's the Eurozone and UK, it's probably a different story. Yeah.
What's the currency you're most excited about at this point? I mean, what is the pound? The pound seems some strength. The Swiss as a haven. You want to be
back
moving
to
into
some of the Swiss names that you mentioned earlier, especially in the financial exporters, the earnings translation is going to come off. Net interest margins, that's going to start coming off as well. Very sensitive to that aspect. And I don't think the SMB, it's going to be President Jordan's last meeting in September. After that, are we going to see a similar framework compared to what we've had in the past? So I don't think they are going to be as activist. So earnings translation in particular, I think that is going to be a weak spot. But our data, our flow data, positioning data shows clients are still underheld in Swiss francs. They're still underheld in yen. So, these are the two currencies I still want to see moving forward. So Euro Swiss lower, Dollar Swiss lower. I still think that's the path of least resistance.
Okay, Dollar Swiss, Euro Swiss, and the fact that many out there are still not allocating to the Swissy and the yen. We've seen those moves, of course, pronounced in the Japanese currency this week, but from a low base, of course. Jeffrey Yu, Senior EMEA Market Strategist at BNY, always lucid with the insights on these markets. Let's check in on the Core 6 this Friday then, on, of course, a very challenged day more broadly for these equity markets. And, of course, we have the names in there like ASML, like Ferrari. And Ferrari was the only one, it's just flicked lower now, in positive territory. It came through some decent numbers towards the end of the day yesterday, but Ferrari now down 0.4%. Nestle on the consumer side, just down 0.1%, so showing a little bit more robust picture. But then in terms of the tech story in healthcare, Novo Nordisk, look at that, down almost 2%. LVMH on the luxury space, luxury again. The challenges of China have tied into the autos and the luxury names, of course, in the last few weeks and months. And we're seeing that again in terms of the picture today. LVMH down 0.8%. ASML, look at that drop, down 6.6% in terms of that key maker of extreme ultraviolet lithography machines listed in the Netherlands, and that read across, of course, from the challenging picture coming through from Intel. So ASML taking a big hit, down 6%. Let's check in on some of the individual stocks and unpack some of these stories and bring in our equities reporter, Joe Easton. Joe.
So that stock, ASML, just opening, as you say, Tom. We had a delayed opening on that stock, just showing us the volatility. Traders couldn't get a price on that one. It was halted at the start of trading, but coming down now 6%. Bear in mind, it was down around 2 to 3% yesterday. So across 2 days, almost 10%. And we're also seeing BE Semi, ST Micro and Infineon, all the chip makers down. The broader move in tech lower. Also that slump in Intel. Apple also not looking great after the close yesterday. All of that weighing on the sector this morning. And we also want to check in on the banking stocks. That's the one I had my eye on yesterday. The Stocks Banks Index yesterday was down the most since March last year, when there was the mini banking crisis in the US. Seeing further declines. SocGen, UBS, Santander, ING, some of the movers at the moment. UBS was one of the biggest decliners on the Stock 600 this morning. All the issues around economic growth, around declining central bank rates coming in at the same time, weighing on margins. That is what potentially traders are pointing to at the moment. A really big move in both of those sectors. Over in Italy, meanwhile, breaking news on a report out of La Stampa. This is an Italian newspaper saying that the Italian government could be looking at potentially another windfall tax on energy, on banks, on insurers, on all of those sectors, in addition to what they imposed a couple of years ago. So we're seeing NL coming down. Also Generali, the big insurer, UniCredit and Banca Monte dei Paschi adding to the broader banking declines. Italy in focus, adding to that fury about some of those declines that we saw yesterday. Then we'll look over at some earnings. Actually, a bit of green on the screen finally, and put these into the context of the broader market decline. Actually, they probably would be bigger if it wasn't for the broader sell-off. So IAG coming up, announcing walking away from Air Europa takeover alongside earnings. Pirelli got some good margins on the tyre maker, and Salvatore Ferragamo, the maker of fancy shoes and handbags, that kind of thing. They've got some good numbers out of them as well, so they're up a little bit. And ENGIE in Paris, the French energy provider, boosting their forecast this morning. All of those finally giving us a bit of positivity on the screen. Also, we're going to check in on the asset manager deal, AXA and BNP Paribas asset manager business. These deal kind of coming through. They are in talks, not confirmed at the moment, but we do look to see a big merger in that sector. So that is a bit of positivity on AXA, at least. BNP Paribas coming down with the broader banking space. Finally, want to bring up Ferrari. You did mention it there, Tom. Actually, an upgrade over at Barclays, overweight on that one, and a 450 price target. A lot of upside, but take a look at the shares. They can't even get a boost given that market sell-off in Ferrari. But Ferrari gets an upgrade. I thought that would be higher. I was a little bit wrong on that one, but at least we do have a bit of positivity in terms of Ferrari this morning.
Well, the broader market not moving in their favour, is it? And just to underscore what, Joe, you were saying there about the banking sector, the energy sector, and fears around government action in Italy, the FTSE MIB is now down by just over 2%. Thanks to Joe Easton from our equities team for bringing us all of the stocks on the move this morning. Then coming up, we'll focus in on one of the names that Joe was mentioning there. AXA shares rise as the French insurer enters talks to sell its asset management unit to BNP Paribas for 5.1 billion euros. We'll go live to Paris for the latest. That's next. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Welcome back to the opening trade. We are 21 minutes into today's session, and it is a challenge session right now across European stocks, down 1.6% after a bruising Asian session. Of course, futures in the US also pointing to, wow, heavy losses. NASDAQ futures. NASDAQ futures pointing lower by close to 2% right now. S&P E-minis also pointing lower by 1.2%. Recession concerns in the US. Tech sell-off, of course, amongst other factors weighing on these markets. Let's get to a deal, though, in terms of the French finance space. French insurer AXA is in the green this morning, one of the rare bright sparks within this equity market. That's after BNP revealed it was in exclusive talks to buy its asset management unit for 5.1 billion euros. The move will create one of Europe's largest money managers. AXA CEO Thomas Buberl told Bloomberg about the deal earlier.
The AXA Investment Management is a story at AXA of 30 years of great success. But when you look, is it big enough to really serve our needs? The answer is clearly no. With BNP, we've got a partner that is very like-minded. We have decided to enter into exclusive negotiations to sell, to really create this strong European asset manager.
Okay, for more, let's bring in Bloomberg's Alex Rajbandari from Paris with the details. Alex, then, how did this deal come about? We heard a bit there about the rationale behind this from AXA. Talk us through how this deal came about and what both sides hope to get out of it.
Well, good morning, Tom. There's been a lot of speculation around the fate of AXA investment managers in the past years. And the reason for that is really the scale. As the CEO said, it was not big enough to compete, in the asset management space. You need to be bigger so that you can request lower fees from asset owners. And it wasn't the case at AXA. And also, AXA has strong growth ambitions in the life insurance and savings sector. And the fact that they didn't have an asset manager that was big enough to compete was kind of a problem for them to support their growth ambitions.
And what are the benefits then for BNP Paribas? So what's in it for them?
Well, for BNP, again, scale is important. Now it becomes one of the biggest asset managers in Europe, behind Amundi and UBS only. So again, it's going to be able to attract more asset owners in Europe and elsewhere. There was something that was quite attractive for BNP within the AXA IM package. It's the private assets. AXA IM Alternatives is kind of a known franchise in that space, and it's kind of a hot topic today in the asset management industry that is set to grow even more. And, the likes of BlackRock are kind of plowing a lot of money into that. So that's important for BNP because it's a leverage for future growth. As well, it comes with a steady stream of income for them because there's a long-term partnership within the deal that allows BNP to provide investment services to AXA for 15 years. So, it's kind of a long-term thing for them as well.
Okay, so that's the rationale. Look, this is all very much in your wheelhouse, Alex. So when you take a step back, what is your assessment of what this deal means for the broader European asset management sector?
Well, consolidation is on. We have seen the bigger ones like Amundi scooping smaller asset managers, but this time it's two subscale yet sizable asset managers combining their strength to become one of the largest ones. We have known for years there was a lot of speculation about potential consolidation in the sector, but small teams know well their worth. They know they could be sold at a higher price, so there was not a lot of moves eventually. This is kind of a game changer, although, there's still a lot of room to grow for asset managers in Europe to catch up with the big names like BlackRock or the other ones from Wall Street.
Alex, thanks very much. Bloomberg's Alex Rajbandari with the latest on the consolidation within that French market. So just because the Olympics is on doesn't mean that French corporates aren't doing deals, Tom. Not everyone in France is distracted by the Olympics.
Managing to pull themselves away from the games was one of the CEOs of one of the banks that we were speaking to yesterday. Was it Crédit Agricole? I believe it was. And he was saying, OK, you've got me at the right time. In the morning, I'm free to focus on business. In the afternoon, I'm engaged with the Olympics. There's some great reporting out of the Wall Street Journal and our own reporters, of course, in terms of the enthusiasm that French spectators have suddenly appeared to found, despite the fact they were pretty sceptical.
With an opinion piece echoing those sentiments, saying they've gone from cynicism to embracing the games, which definitely chimes with my 2012 experience. I mean, it's been fabulous to have all this sport to watch, and it continues. So that is where we are. The market's front and centre, down by 1.6% this morning on the Stock 600. So we return to that shortly. We'll also get you an update on some of the geopolitical issues we're dealing with this morning. Coming up, President Biden greets Americans freed in the biggest Russian prisoner swap since the Cold War. Details next. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. We do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
This is the opening trade, 30 minutes into today's session, and European stocks taking a big hit after Asian stocks had a, frankly, walloping in their session. US futures also pointing to significant downside, despite the fact that selling yesterday was pronounced. The Russell 2000 ending lower by more than 3% yesterday. European stocks right now, as a benchmark, down 1.4%, and the heaviest selling coming through for the tech sector, where names like ASM, BE Semiconductor, ASML, ST Micro and Infineon all down between 3 and, take this, 7%. ASM down 7.8%. ASML down 5.2%. And part of that is down, of course, to the read across from the softness in terms of the earnings story and deep concern about Intel's future as well. So European stocks deeply in the red this morning. Let's get the details in terms of how this is all unfolding across the tech sector, what the pain point is, and how we should be thinking about the next few days and weeks. And bring in, of course, Matt Bloxham from Bloomberg Intelligence. Matt, just talk to us about the read across to Europe and whether or not it's rational. Is this a broad-based selling that we're seeing, because it looks like that, or is there some real concern about the sustainability of profit margins and earnings for these companies going forward?
I think it's a mixture, although obviously we saw a lot of broad-based buying of the whole AI story, and now it's broad-based selling because people are still trying to figure out who really are the winners and losers. I think there is a specific read across with Intel, though, because Intel yesterday guided to a 20% or more reduction in gross capex for this year and potentially lower next year too, and so that kind of has a direct feed through to people like ASMI, and it's clearly going to affect them. I think when you look at the kind of bigger picture of the tech results, what you're seeing is a lot of investment by the really big tech players in the AI platforms, but a lot of that goes to one or two very specific players like NVIDIA. And what we're seeing more broadly, and we heard this from Microchip yesterday, and we've heard it from lots of others, is that certain segments of the market that drive chip demand, like EVs, for example, and industrials, are proving to be weaker than expected. Inventory levels are building up again. So if you look at the second half here, we've seen a lot of it the last couple of days. Inventory levels are going to be high. Customers are going to be winding down their inventory levels. So that's going to slow down the pace of new order demand. And obviously on top of that, people have got growing concerns about the US economy. By far and away, the US economy is really, in terms of corporates, is what drives the kind of whole digital AI transformation story. And so if corporates are slowing down their investments in that technology transformation, that's going to feed through to a kind of slower evolution of the market too. And that ends up kind of dripping through all parts of the market.
And so Matt, it's interesting. So you're describing there something kind of cyclical that relates to weakness in the US economy and the slowness we're seeing in autos and all of the various end markets there. And this is what we were trying to, we were talking this through with Jeffrey Yu earlier on in the programme. To what extent will investors have patience, and they don't seem to have much this morning, have patience for businesses that want to continue to invest through that cyclical weakness? Because if the structural story around AI investment is still there, you could see reasons to do it, but would the market become overly sensitive to that?
Yeah, I mean, I guess we're seeing the market is overly sensitive to it, but that's maybe just because of how quickly the market has risen. I think you're right. I think there are clearly some big players that the market has complete confidence that continuing to invest is the right thing. So people like Amazon, Google, Meta, all these big players, they are dominant in their markets today, and if they don't continue to invest, they're not going to be dominant in the future. So it's kind of an essential investment. And there are clearly, some big players like NVIDIA, where people kind of see confidence, these business with strong market positions, and they're going to reinforce that. I think beyond that, there are more question marks about where some of the kind of more marginal players, we're seeing this a bit with Intel too, but, do they have the right strategy for the AI future? Have they been doing it quick enough? And can they kind of scrabble their way kind of out of a difficult spot? And I think that's the bigger question mark.
And what you've really brilliantly pointed out is that investors in the tech space have to do a lot more homework in terms of picking out the potential winners and picking out those who are more vulnerable. And you talk about the EV softness, the inventory story, the smartphone business that hasn't come back unless you're at premium level. There's all these details, granular details, whereas before the start of this year it was just buy the bunch. And so that's what you're breaking down for us, which I think is really important. As you look forward then, and I wonder to what extent some silver linings came through for Amazon, for example, around cloud, whereas that was a bit of a challenge for Microsoft and Alphabet. When you think about Amazon, because it has that touch point on the future around cloud, but also on the here and now of e-commerce, what is Amazon telling us?
Contrasting stories. So, the here and now on e-commerce is weaker than expected, partly because of things like the Olympics distracting people, partly because of the economic softness in the US. I think they said customers are looking for deals, and there's also some kind of Chinese rivals that are kind of encroaching into that e-commerce space too, which was a challenge for them. And also on the flip side, AWS, Amazon Web Services, their big cloud business, the market leader, stronger than expected growth. Their kind of investments and their market position continues to be really good there, but unquestionably their business will be impacted by a soft economic outlook, because if companies are investing less in technology or winding down inventory, then they're not going to be driving incremental demand in new capacity in data centers, whether they're Amazon Web Service data centers or somebody else's. So that will undoubtedly affect maybe the near-term growth that they can expect.
Matt, thank you very much. Thanks for joining us once again. Matt Bloxham from Bloomberg Intelligence team. Now, we are seeing weakness across risk assets, concern around the growth story in the United States and in China, concern around where tech stocks go. Not much evidence that geopolitical concerns are to the fore when it comes to investors' thinking this morning. Let's dive into some of the geopolitical themes, though, that are lurking and need coverage. The Wall Street Journal reporter Evan Gershkovich is back in the United States after being freed in the biggest prisoner exchange between Russia and the West in decades. Gershkovich was released along with former Marine Paul Whelan and another journalist with dual Russian and US citizenship. The president and vice president greeted them as they arrived at Joint Base Andrews.
The toughest call on this one for other countries, because I asked them to do some things that were against their immediate self-interest, and really very difficult for them to do, particularly Germany and Slovenia. Slovenia came in at the last minute, and I tell you what, the chancellor was incredible. I don't buy this idea that you can let these people rot in jail because other people may be captured.
This is just an extraordinary testament to the importance of having a president who understands the power of diplomacy.
Let's get more on the story with Bloomberg's Russia economic and government editor, Greg Sullivan. Greg, good morning to you. So what do we know about the diplomatic effort that went into this and how long it took to bring it to a conclusion? Because there were a number of nations involved here.
That's correct. This was a multinational deal. It was in its size and scope. We really haven't seen something like this since the Cold War. So a huge effort that has been ongoing for months, really. We know that earlier this year, Putin said that intelligence agencies were meeting with each other. We know that the U.S. has been trying to bring home Gershkovich since he was originally detained in 2023. And in the case of Paul Whelan, that's been a multi-year effort. We know that the administration did try to get him included in the deal when WNBA star Brittany Griner was swapped. So really a lot of effort across a lot of different countries and a long time in the making.
How much of a win is this for Vladimir Putin, essentially? Because they have their people, assassins in some cases, arrested, and they go through the proper legal format with the transparency and evidence presented. They go through the court cases, and in these cases they've been found guilty and they are jailed. On the flip side, Russia just picks up a journalist, there's no evidence, and frankly many would say it was a sham trial. This is a win for Putin?
It certainly was. Vadim Krasikov, the Russian that came home that you're referring to, he was really key to the deal and pulling it off. There was a lot of reluctance from Germany to release him because, as you said, he was convicted in a trial. The murder that he pulled off was very brazen. But for Putin, he can basically use bringing Krasikov home as a signal to agents in the field that Russia has their back, that Russia will do what they need to take them home. And Putin was very pleased with this. This is the man that he wanted to bring home, and he was able to secure his release. It was truly key for the deal to actually go down. So for Putin, he's probably viewing this as a victory right now.
Where does this leave, Greg? Where does this leave broader Russia-US relations? Still in a poor state. I suggest I would guess, because I mean you've still got Ukraine and Russia fighting on Ukrainian territory, and the US supplying the Ukrainian war effort. Does this tell us anything about the broader politics between the two?
That is a great question. U.S. and Russian relations are at a low point, probably the lowest since they've been since the Cold War because of Russia's invasion of Ukraine. But they've been deteriorating before that, and this is probably not a signal that they're going to improve that much. But what is significant here is that there is still some diplomacy in the realm of these prisoner exchanges, that there is contact over prisoner exchanges that happens even when all the other relations, other realms have pretty much deteriorated. So I wouldn't look for a reapproachment between Russia and the U.S. at this point, but it is significant to see that they are still communicating in this one sphere.
Okay, Bloomberg's Russia economic and government editor Greg Sullivan with the details on this historic moment in terms of this swap that we've seen, of course, between Russia and the US and some of its allies. Greg, thank you very much indeed. Up later as well on this story, former UK ambassador to Russia, Laurie Bristow, joins the Pulse, 9:30 a.m. UK time. So tune in for that as well, the reaction, of course, to what we're seeing in terms of that spy swap. Coming up, President Biden vowing more support for Israel as Iran and Hezbollah ratchet up their threat. We get the latest on the Middle East. That's next. This is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So, yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Africa's mineral wealth offers a $1.6 trillion opportunity,
and governments want to cash in. With near record copper prices, companies are restarting dormant mines. The host countries are demanding more of the proceeds. For the first time, the Democratic Republic of Congo has started directly selling its share of copper from joint ventures and is doing the same with cobalt. This means more revenue for Congo than going through the JVs. Meanwhile, neighboring Zambia is setting up a state-owned metals trading company, competing directly with the likes of Glencore and Trafigura, as well as increasing its stakes in mines operating in the country. Such moves reflect a wider shift across the continent as governments seek greater economic benefits from their natural resource wealth.
Gone should be the days when Africa is just seen as a source of rock, soil, dust being exported out of our continent.
Ghana aims to refine its lithium within its borders, earning more, while Botswana wants a bigger stake in diamond miner De Beers. Demand for critical minerals is set to soar in coming years. Bloomberg Intelligence sees global copper consumption increasing by 2 million tons by 2030 amid the green and AI booms. Africa is taking steps to ensure it gets a bigger share of these vast riches.
That was Bloomberg's Samuel Etienne there on the new steps African governments are taking to capitalise on their resource wealth. Now, let's move on to other stories this morning. President Joe Biden has promised Benjamin Netanyahu, quote, new defensive U.S. military deployments as Israel faces fresh threats to avenge assassinations of Hamas and Hezbollah leaders. But the president also pressed the Israeli leader to move forward with ceasefire efforts. Joining us now to talk about these latest developments in the Middle East, Jane Kininmont, Policy and Impact Director at the European Leadership Network. Jane previously held roles with the Elders, Chatham House, and The Economist, specialising in the Middle East and North Africa. Jane, nice to speak to you this morning. So let's start with the latest developments here. President Biden promising Netanyahu new defensive US military deployments. What do we think that could look like? What should we expect to see from the US in terms of its assistance here?
Well, it may refer partly to what the US did when Israel was recently attacked directly by Iranian missiles. They may well be thinking that Iran's retaliation could include more direct strikes on Israel. And when that happened before, Western intervention was key in protecting Israel. But at the same time, Biden has been sending the message that the assassination of Ismail Haniyeh was not positive, to say the least, for ceasefire talks. So it continues his strategy of offering Israel support on the one hand, but putting pressure on it on the other.
And what kind of response in terms of Israel having to defend itself from what, I suppose, is the next question, because we saw weekend attempted attacks on Israel the last time we were thinking about this. This time around, some people are making quite a big deal of the fact that the Hezbollah leader, Nasrallah, has talked about these killings of Hamas and Hezbollah leaders as crossing a red line, but not calling for all-out war at this point. I mean, does that give us any comfort in terms of the level of escalation we're going to see?
To some extent. I mean, it's probably still safe to assume that the major players here do not want all-out war. But what's been happening for the past few months, and indeed slowly building for years before that, is that everyone's risk appetite is increasing, and they're trying to test the risk tolerance of their adversaries. So they're taking more and more risks. The mediators, including the US, seem to be struggling to restrain them, and there could be miscalculations that do result in a bigger war.
Is it your assessment, Jane, good morning, that we see a repeat of those direct attacks by Iran on Israeli territory, or do they attack via some of their proxies, like the Houthis, like Hezbollah, like Hamas? What are the options that Iranian leaders are likely looking at in terms of retaliation?
As you say, Iran has quite a few options. We also can't rule out that they might try assassination or terror attempts on Israeli targets abroad in third countries, although that would also get them into hot water with whatever third country was involved. At the same time, what we have seen since the October 7th and the onset of the Gaza war is that generally Iran does not want to go to war for Hamas. They will want to respond in some way because they won't want to be seen to be humiliated and not respond, but they will be calculating how can they avoid escalation. We don't see anyone de-escalating, but we do see all sides trying to keep some kind of lid on things.
How closely aligned are Hezbollah to the decision-making? They have the support in terms of weaponry and finance, clearly, from Iran, but in terms of the decision-making, to what extent are they autonomous? Because they are seen as the biggest threat in terms of those proxies.
They work very, very closely together, and Iran really pushed Hezbollah to help it in Syria during the war there. But at the same time, Hezbollah does have some autonomy. It does have its own interests. It has some of its own sources of finance, so it's not just getting money from Iran, but from Lebanese diaspora around the world. So they will be feeding into Iranian decision-making, not simply being controlled by Iran.
According to our reporting, we've seen intermediaries being used by the Biden administration to try to get messages to Iran, to Hezbollah, to the Houthis in Yemen as well. What does that look like, and what kind of role can they play?
So this administration has been very good at back-channeling. In some cases, it is deploying its own diplomats, such as the envoy Amos Hochstein, who often goes to Lebanon and has been trying to find ways to de-escalate between Israel and Hezbollah for months. They also work through regional leaders. So one of the important factors that does help some restraint is that most of the leaders in the region do not want to see a conflict, and many of them, whether they admit it or not, talk to both Iran and Israel. So countries like Saudi Arabia, Turkey, Qatar are trying to calm things down, but also some of them look weak as things are not calming down and their de-escalation efforts are really wearing thin.
Yeah, we certainly want to get your views on where the ceasefire talks stand. But before that, in terms of the calculation of Israel, they seem to have this kind of Munich-style list of Hamas leaders, certainly, that they're going to go through and take out over time. And we've seen that come to play. And arguably, put aside what you think about the conflict, it's been a successful week for the intelligence agencies of Israel. The challenge to that is risking this conflagration. Israel would say this gives them a stronger hand in terms of negotiations. Where do you stand on that question?
Well, when they were assassinating the members of Black September after the Munich Olympics, they were not trying to negotiate with that group at the same time. And what has really bedeviled the ceasefire negotiations is that these have been taking place tactically with Hamas at the same time as the Israeli government is sworn to destroy the group. It's kind of amazing that talks can take place at all under such circumstances. But there are risks now, because Ismail Haniyeh was one of the most involved Hamas leaders with the ceasefire talks. There are some questions about whether Qatar will continue their role, because they have been saying, how can we mediate if some of the people that we're negotiating with are liable to be assassinated at any point? But we might see Egypt take up more of a role. There is still an overriding regional interest in getting a deal.
So you think the ceasefire talks are still viable? At least there's still an option. There is still the hope that maybe the ceasefire talks can make progress.
There aren't many other options. I mean, at the end of the day, there are things that Hamas wants out of negotiations. It does want some of the military pressure off it, and it still has the hostages being used as a bargaining chip.
So interesting to see that in another field of operation, President Biden using the end of his presidency before November to achieve things on prisoner swaps with Russia. And I wonder if, because he is not contesting this next election, whether that leaves room for him to engage more with this, and whether that is an area that, is that a reason progress can perhaps be made?
It can be. I mean, he's been extremely engaged personally since October 7th now. And I think that, he and this administration have got a strong interest in diplomacy, even with adversaries. We've seen them also offer nuclear arms control talks to Russia, even with the current state of affairs and the ongoing invasion of Ukraine. They're always looking for options for diplomacy. And that's also relevant to Iran. So something else happened yesterday. Iran brought back its former foreign minister, Zarif, who was one of the key champions of the nuclear deal with the US. He's now a new vice president in Iran, and he'll be looking to have some kind of contact with the US.
Okay, Jane, thank you very much. Thanks for joining us. Jane Kinnan-Mott from the European Leadership Network. Thank you to Jane for joining us, and we'll certainly keep an eye on developments in the Middle East through the weekend. Here's what we're watching for in markets, though, before that. 1:30 p.m. UK time, we'll get US jobs data, payrolls and unemployment. We'll get the latest take on what seems to be cracks emerging in the market, and we saw that certainly yesterday in some of the data. Then 3 p.m. UK time, US factory orders and durable goods. Later, we'll get numbers through from Exxon and from Chevron, so plenty of corporate data coming through. But right now, our focus then, Tom, turns to what we're seeing in markets and weakness in technology names here in Europe?
So technology taking an absolute shellacking right now in terms of the sectors across Europe. Part of that is down to what we saw in terms of the softness came through from Intel, a terrible set of results there, and also concerns as well coming through for Amazon. Apple, it was a little bit more mixed. But yes, the big chip makers, the likes of ASML and Infineon, STMicro, also all taking big hits between 3 to 7%, 8% on ASMI, which is currently down a little over 8%. So tech is taking a really big hit. We've also got a story around Italy. So the FTSE MIB is one of the biggest losers, is the biggest loser in terms of your main indexes, down 1.6%. And this is down to a story reported out by local media, La Stampa, suggesting that the Italian government may consider a possible levy on Italian banks and insurance companies. So the banking and finance sectors within Italy.
Yes, and so we're seeing that coming under pressure. It would be an extraordinary tax proposal. It's not ready to be discussed in cabinet, so there's no sense of urgency in that this is coming imminently. And you're right, you pointed out earlier, Tom, when we were looking at this in a break, that, you know, haven't we been here before on the Italian story? And we certainly have. We've seen rumours, and we saw rumours last summer that something like this would happen. A year ago, the Italian government really surprising investors by proposing a windfall tax. That was just on the banking sector. So this seems to go further, but then they backtracked from that and watered down that law. So we are seeing investors sell first and ask questions later, but you wonder where this conversation goes from here.
You'd imagine there's some investors there saying, wringing their hands, saying, not now, not on a day like today, where you're seeing all these concerns about whether or not we're actually facing a hard landing, whether or not the Fed and other central banks are behind the curve, whether or not the tech story is now dissolving before our very eyes. We look ahead, of course, to non-farm payrolls later today after jobless claims came in higher than expected. We'll be looking at the wage components. Interestingly, expectations in terms of Bloomberg Economics is that average hourly earnings are expected to come in, the increase, 3.7%. That would be the least in 3 years. The top line number in terms of non-farm payroll expectations are 175,000, down quite significantly from above 200,000 in their most recent print. Unemployment, of course, that level will be scrutinised. 4.1% is the expectation. If you get much above that, though, that could add to the bets around treasuries.
And certainly this is adding to our understanding of the labour market, which we improved yesterday. We improved our understanding of the weaknesses in it, didn't we, over in the United States? A couple of data points weighing on sentiment around the growth story in the United States. Jobless claims, the worst since August 23. ISM manufacturing, the employment gauge, down at 43.4. All of that, yes, leading to risk-off sentiment in markets, including, as you say, a 7-day rally in treasuries, or adding the 7th day, the longest winning streak there for treasuries since early 2020. So another underscoring of the risk aversion that we're seeing across these markets. That is it for the opening trade. I'll be back with the pulse shortly. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Could face bigger challenges elected. Was going to keep Real World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
European stocks slide as soft US data sparks a global sell-off, with Japan's Topix suffering its worst drop since 2016. Treasuries gain for a 7th straight day ahead of today's jobs report. Tech troubles, Intel plummets as sales slump, while Amazon tumbles on its plan to increase AI spending. But Apple says it expects a boom from its AI features. Plus, President Biden welcomes home Americans freed by Russia in the largest prisoner exchange with the West in decades. Let's take a look at where we are on markets there, and a sort of multi-pronged sense of nervousness around risk assets this morning. This is the selling that we're seeing across stocks. You can see the Swiss market actually down by 2.3%, the FTSE 100 down by 0.3%, the DAX down more than 1%. The Italian MIB is where we have a great deal of weakness coming through this morning for the banking sector and oil names. We'll roll on and show you a cross-asset check that illustrates the negativity we're seeing in Italy, and part of this being driven by local media reporting about the possibility of a windfall tax. We've been here last summer, but certainly it's something moving markets, so we'll see where that goes. S&P futures suggesting further nervousness ahead. The tech sector weighing on NASDAQ expectations as well. The US 2-year yield in focus. We're seeing buying of bonds, 7 days of buying of bonds as nervousness around the US economy and what kind of landing we get for the US economy is in focus. Brent crude then on the week is actually weaker as we are concerned around the growth story in the US and over in China. But today we see a bit of an uplift, up by 1%, still keeping geopolitical risks in focus. Let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards in for Francine Lacqua in London this morning. Let's start with a focus on tech stocks then. Tech stocks have slumped after Intel and Amazon earnings disappointed investors. We are seeing some pre-market trading over in the United States then now, and this is the extent of the negativity attached to, in particular, Intel, also Amazon. Amazon announced heavy spending on AI as Intel reported a grim growth forecast and job cuts. Apple, meanwhile, predicted its AI features will spur iPhone upgrades in coming months, and we certainly don't see the worst of this falling on Apple this morning. We will discuss what all of this means for markets shortly with BlackRock's Ursula Marchioni, who's with us in studio. But first, let's bring in Matt Bloxham from Bloomberg Intelligence, who's been keeping us through the morning up to date on all of the tech stories. Good morning to you, Matt. Let's start with Amazon, which is one we have not mentioned quite as much, perhaps. Yeah. But I wonder if this has more read across than some of the other stories we're going to discuss in the tech space this morning. But tell us about what it is that Amazon said.
Yeah, sure. I mean, obviously, two very different parts of the Amazon business, the e-commerce business and Amazon Web Services, their cloud business. Contrasting fortunes, the e-commerce business struggling a little bit with sluggish consumer demand, with distractions from the Olympics they talked about, but also consumers continuing to look for deals and also some rivalry from kind of Chinese alternatives kind of impacting that business too. The cloud business doing better, 19% year-on-year revenue growth, better than the market expected. But as you said, these really heavy investments in AI platforms, which aren't really yet kind of translating into the real big growth burst that the market's looking for. So it's kind of like big bets today, but hopefully a payback in the longer term. And actually we heard early in the week Meta say that actually we're probably all spending way too much money right now on technology, but we need to, because if we don't, we'll lose our position in the market in the mid to long term. So I think it's that disconnect between the amount of investment today and when it's going to pay off and how big that payoff is going to be. And then when you connect that into what's going on in the global economy, and particularly the US market that seems very weak and probably going to get weaker, corporate spending on technology transformation is ultimately what ends up in Amazon Web Services facilities and drives their revenue. And if corporates are holding back on those big AI-based technology transformations, that's going to slow the pace of that revenue pickup too.
Then that takes us on to Intel, and talk to us about what's going on at Intel, because that seems to be a much more dramatic story from what we're seeing in the share price reaction. But I wonder how idiosyncratic just about Intel.
Well, I guess it's idiosyncratic in the sense that they are the wrong side of the AI story. You know, they're trying to play catch up, and it's not really coming through yet. So we had this kind of big downgrade in the forward revenue guidance. So I think it was at $12.5 to $13.5 billion. The market's looking for 14, and you know these big cutbacks in headcount. 15% or more of headcount reduction, a 20% cut in gross capex tells you that the management team are looking at the forward view and thinking, wow, this isn't coming back anytime soon, and we're struggling both in terms of inventory build-up in clients, but also the rivalry from people like NVIDIA. Basically all the server demand, which used to benefit Intel massively, is now going to people like NVIDIA, and their AI PC strategy is really being a bit slow to kind of pick up. So there's going to be this big gap and a big question mark about whether they're doing enough and can do enough to claw back and kind of find some kind of strong position in the mid to long-term AI market.
Meanwhile, we have Apple, and I mentioned earlier that Apple was not seeing the worst of the drops in pre-market, and that seems to be the case. They still have their big sort of AI delivery ahead of them, don't they? And maybe are we just treading water until we see what so-called Apple Intelligence will deliver? Yeah, that's right. So in June, they announced Apple Intelligence. I think the excitement from then has been around this driving a new smartphone super cycle. I'm a good example. I've got an iPhone 11. Every time that the 12, 13, 14, 15 came out, it's like there isn't anything good enough here for me to upgrade and spend another $1,000 on a phone. Maybe the first time AI features is going to be enough to make people like me upgrade their phone. And so I think the hope and expectation is, and we certainly heard this sentiment from Apple yesterday, that those AI features are going to really drive a stronger upgrade cycle among their customer base. Now, iPhone revenues improved in the quarter just reported, but they're still down about 1%. And so, given that that's around 50% of their revenues, they really need the iPhone segment to be kind of performing much better. And so the hope and expectation is that iPhone 16 will move that from a shrinking revenue base to a growing revenue base and drive profitability. And in the meantime, they try to reassure people about what they're doing on iPads and the China business. That was all part of the conversation as well. Thank you very much, Matt. Thanks for joining us. Matt Bloxham from Bloomberg Intelligence with the details on the tech sector. Joining us now, Ursula Marchioni, Head of Investment and Portfolio Solutions EMEA at BlackRock. Very nice to speak to you, Ursula.
Good morning, Anna.
Volatility in the AI trade has been something that we've got used to. At the beginning of this year, it was a kind of all-out, everything with AI attached to it seemed to generate huge amounts of enthusiasm and therefore high valuations. Then the market lost its nerve around some of those tech names, and now we just seem to find a whole lot of volatile. What are your takeaways from what we're hearing on AI at this point?
Absolutely. So maybe taking a step back, I think this is a spectacular proof point of what we've been discussing for quite some time. The post-pandemic world requires a completely different approach to portfolio construction. We will be open to faster rotations that have deeper impacts on portfolio performances. We need to live and adapt to this new world. And I think the second half of July really shows this in practice. So having said that, how are investors reacting? So July for me has been, extremely an element to watch really, really closely. At high level, it's very different from, a 2022 linear de-risking. Investors have continued to deploy money into the market. But to your point, I think the theme is broadening of the areas that are being looked at. So if I think at records, and I think this is where maybe, there's an interesting disconnect. Today we're seeing this sea of red, but if I look at the full numbers for July, we have seen record inflow into markets through exchange-traded products, 192 billion. Within that, there's a record, all-time record for fixed income purchases at global level at 58 billion and in EMEA at 10.6. So again, you can see that it is really an element around thinking about more dynamic asset allocation and more granularity in the exposures that we pivot towards.
Does that flow into fixed income products that you described, though? Does that tell us something worrying about expectations for the global economy or the US economy? Does it tell us about that macro jobs nervousness?
Yeah, great question. And so I'll give you an answer. In the US, we've seen actually broad buying of both rates, but also credit. In EMEA, of that 10.6 billion that I mentioned, 3 went into investment grade. So again, you can see that this is not a full risk-off story. Now, going back to the AI theme that you touched upon, there's a lot of color coming through in terms of investor sentiment through sector flows. So again, are we seeing the double-digit billion that we saw earlier in the year, in the first quarter, going into tech sectors? No, but it's still a very solid 6.5 billion. So there isn't a rotation out of it. What we're seeing, again, is a broadening towards financials at 2.6, industrials at 1.3. So it's really, for me, that element around the dynamism, the granularity, and the broadening.
Yes, and is that something that then delivers for Europe, that broadening? Because that had been an expectation. Certainly when we started to see a bit of selling in big tech last month, there was an expectation that, yes, it goes into small caps perhaps in the United States, maybe it benefits Europe as well because of the sector exposure that Europe has. But has that really delivered, Sheila? Or are we still waiting for that to deliver?
Well, some has come through. Like, we have seen, active European equity mutual funds turning positive for the first time in 18 months. We have seen purchases of European equities, including from US investors, throughout the first half of the year. Over the last 3 to 4 weeks, I have to say the purchases have continued, but it's been more localized for European investors versus international ones. But there is some of it that is coming through, although again, loads ahead for us to reflect on.
Yeah, a lot to reflect on, for sure. And I wonder what to reflect on Japan as well. You mentioned in your notes ahead of this conversation the importance of portfolio diversifiers, such as Japan. And Japan has been such an exciting place for investors for quite a long time. Now we see correction, though. The topic's entering correction territory, falling 13% from its July peak. That's a big drop quite quickly. Is this all about the macro, the yen story, where that goes with the BOJ moving in the opposite direction to other global central banks? And how much does that matter to you as an investor?
Yeah, so there's quite a lot of things that are coming into this, everything that you've mentioned. And in addition to that, there's a liquidity profile that pertains to Japan. When risk-off kicks in, Japan typically in APAC is the first exposure that you sell because it's the most liquid, it's the easiest one. And then once you've done that, then you'll think about your Chinas and your Indias. So I would take that into the picture of what's happening today as well. Now, taking a step back, it's interesting that you mentioned, Japan has been a great story, particularly in Q1, into Q2 with some moderation, but persistent. Investors, though, haven't come back to it completely. So if I look at our EMEA clients, they are still underweight vis-a-vis benchmark from a strategic perspective, Japanese equities. So you can still see play now the structural under-ownership from, decades of deflation. So the structural story around coming out of deflation, obviously with the consequences of a BOJ being the odd one out in terms of central banks, corporate reform coming through, balance sheet becoming stronger, and in general earnings, although the picture is multifaceted, but broadly speaking, they are coming through. I think that still presents from a structural perspective an opportunity. Now, you're right in pointing out the yen, because while in the first quarter, I would have said, probably think about hedging that, going forward from a structural perspective, I think an unhedged position. As we rectify a structural under-ownership, the underlying long-term story is intact. Coming out of decades of deflation, with finally the third arrow of Abenomics coming through, is powerful. Investors haven't fully captured it, and this can be a good entry point to do that.
Okay, so it could be an entry point. Thinking about the day ahead, then, as we're going to be heading towards the non-farm payrolls later on today, another data point adding to our understanding of the jobs market in the United States. We got quite spooked by some of that data around employment in the ISM data yesterday. Did that shake your confidence in the US growth story? How do you put that job story into context?
Yeah, well, clearly we are heavily concentrated on data, and we need to continue to do so. And so is the Fed, given the latest communication. So again, today is an important day, and equally going back to the earnings discussion, that is an equally pivotal moment for us. We're getting through to towards 50% of the reporting season so far. Vis-a-vis year-on-year estimates that we had entering into the reporting season, around 9% for the US market, we've seen earnings coming through. There's some idiosyncrasies. I think that's what Matt mentioned. But we've seen about 12% of that growth coming through. So it is continuing to deliver, but we need to be very, very concentrated on what happens for the remaining part. Broadly speaking, that big mega force story behind AI tech, which is a big propeller for the US market, is still there. We shouldn't fret, we shouldn't doubt the mega force component, but it will go back to what's the investment horizon for the portfolio that we're looking at. Is it more strategic or tactical?
Ursula, thank you very much. Thanks for joining us. Ursula Marchioni, Head of Investments and Portfolio Solutions EMEA at BlackRock. Coming up on the programme, the Bank of England's first rate cut since COVID. We will dig into the prospects for the UK economy next. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome back to The Pulse. I'm Anna Edwards in for Francine Lacroix this Friday morning. Joining us now to talk about the UK, Dan Hansen from Bloomberg Economics. And Dan, we sat here yesterday listening to the Bank of England, to the Governor, talking about the UK economy and giving us his take on where it goes from here. And we saw this first cut in interest rates. Given some time to digest how the market has responded, we did see quite a big drop in the pound on the back of this and some reassessment of the number of rate cuts we're going to get. Do you think the market has taken the right message away that we'll get more rate cuts then from the Bank of England?
I think they've definitely taken the right message. I'm quite shocked actually that we've got now 2 more cuts priced for this year. There are only 3 meetings left, so that the implication there is they're going to go back to back potentially with rate cuts. I mean, that sort of, for me, that sort of jars slightly with the message that Bailey sent, which is, this very cautious message about this is a reduction in restrictiveness. There's not really any talk about easing. It's just about letting your foot off the brake a little bit. So for us, I think they'll probably do 1 more rather than 2 more, just when you're thinking about this year. And I think I think a reasonable expectation is to stick with the sort of quarterly profile. So they stick with their monetary policy reports, and that allows them to use the press conference. It allows them to produce a forecast to explain their decisions.
Okay, so the market may be expecting too much in terms of rate cuts. Is that because inflation will be stickier than thought? We spent a lot of time also hearing from the BOE yesterday about this framework for thinking about what kind of economy the UK now is, whether it is like the pre-COVID one or whether post-COVID there's something structurally a bit different that makes it respond more slowly to the rate hikes that we'd seen. So do we think inflation is going to be stickier and that's why we won't get as many rate cuts?
I think in the near term that's the right domestic motivation for thinking about it. I mean, I think one reason why investors have boosted their bets on Bank of England moves is what's going on in the US. You know, there are concerns about the growth picture there. And that obviously, as you said yesterday, rightly, it all spills back into the UK. But I think the UK story and what the Bank of England will be looking at is, as we know, the sort of services inflation picture, the domestically generated inflation picture. And I think that's the thing that will make them a little bit cautious about going too quickly. And again, that seems completely consistent with what Bailey's been saying. You're right that we've got these two thought processes, haven't we, about how quickly inflation will fade. One is sort of this, I guess, relatively benign scenario where we get back to target, or we rise in the near term, but then things fall back fairly quickly. The other one is it takes a lot longer and rates are going to have to be higher for longer in order to deal with that. And obviously, 4 on the committee appear to be placing quite a bit of weight on that, which is why they didn't go for the cut. 5 are sort of more on the sort of more benign scenario, but I think, you know, that vote split tells you how finely balanced it is and how difficult these decisions are going to be going forward. Yeah, 5-4 then. Dan, thank you very much. Thanks for joining us. Dan Hansen from Bloomberg Economics. We'll bring you some of our interview with the Bank of England Governor Andrew Bailey a little later on. Coming up on the programme, AXA shares are in the green as the French insurer enters talks to sell its asset management unit to BNP. Scale, it seems, is important in this market. Details ahead. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Welcome back. BNP Paribas is in exclusive talks with AXA to buy the insurer's asset management unit for 5.1 billion euros, a move that will create one of Europe's largest money managers. Let's get more from Bloomberg's Alexandra Rajbandari. Alex, nice to speak to you. How did this deal come about? What's the rationale for AXA?
Well, good morning, Anna. Well, there were a lot of speculations around the fate of AXA investment managers in the past years. The main reason for that is scale, because the asset, though sizable, is kind of subscale compared to other players in the sector. And, you know, executives at AXA have said this morning and yesterday that they realized that the unit was not big enough to compete against others in order to request lower fees from asset owners and attract more of them, but also would not be big enough to support the growth ambitions of AXA in the life insurance and savings space, for instance.
Okay, so there's a scale story there. And what are the benefits for BNP Paribas?
Well, for BNP, one of the benefits is also scale, because now it's becoming one of the biggest asset managers in Europe, behind only Amundi and UBS. But also, what was interesting for BNP into AXA investment managers is some franchise in the alternatives assets and private markets in particular. It's quite a known franchise on the market. And, you know, it's a hot topic in asset management. All players are trying to get their hands on it. And, you know, the likes of BlackRock are applying a lot of money in it. So this is definitely a game changer for BNP in that sense.
Alex, thank you for your time. Bloomberg's Alexandra Rajbandari with the latest on that M&A story. Coming up, we'll talk geopolitics. We'll speak to the former British ambassador to Russia, Laurie Bristow, after the biggest prisoner swap between Moscow and the West in decades. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. Welcome to the Pulse. I'm Anna Edwards in London, in for Francine Lacroix this morning. Here are your top stories. European stocks slide as soft US data sparks a global sell-off, with Japan's Topix suffering its worst drop since 2016. Treasuries gain for a 7th straight day ahead of today's jobs report. Tech troubles. Intel plummets as sales slump while Amazon tumbles on its plan to increase AI spending. But Apple says it expects a boom from its AI features. Plus, President Biden welcomes home Americans freed by Russia in the largest prisoner exchange with the West in decades. Let's go to the tech trouble headline and show you how we are trading in pre-market, US equity pre-market then. This is how some of those big tech names are trading. Your eye is drawn instantly to Intel, down by 22% pre-market, and this on the back of a cancellation of a dividend, and it seems that a business that's on the wrong side of the AI trade right now. So we'll see how that one trades through the morning, and whether there is legitimate read across from Intel into other stories is an interesting one to think about. Amazon also weak on the extent of its capital expenditure in AI, as we got numbers through from that business. Apple a little more resilient. In terms of where we are on Europe, where does that leave Europe? Well, Europe is seeing some weakness in some tech names. So ASML was actually suspended at the start of trade, but now trading, but weaker. And we do see tech as one of those weak performers in Europe today. So the stock 600 is down by 1.4%. We also see some weakness coming through in other risk assets and some appetite for treasuries, for bond markets, essentially. We have the yield on the US 10-year down below 4% at 3.95%. So that's where we are on the Treasury market story. And US futures also trading weaker, as you see, down by 1%. So further to go on the selling, driven by tech, driven by nervousness around the US economy. Let's pivot to global geopolitical concerns, though. President Joe Biden has promised Benjamin Netanyahu, quote, new defensive US military deployments in a call between the two leaders as Israel faces fresh threats to avenge assassinations of Hamas and Hezbollah leaders. Let's get more. Bring in Bloomberg's Horizons Middle East and Africa anchor, Jemana Besetcha, who is with us this morning. Jemana, good morning. What do we know then about Biden's call with Netanyahu and what the US is promising to Israel?
Yeah. That's right. So President Biden did have a call with the Israeli Prime Minister Netanyahu on Thursday evening. A White House readout of the call said that the president had discussed Israel's efforts to support its defense system, and that there had been further discussions about the possibility of U.S. supplying Israel with further military equipment. This, of course, as Israel is now on a high state of alert, the Prime Minister Netanyahu saying yesterday that the country is in a very high level of preparedness in anticipation of a retaliation out of Iran or its proxies in the region after the taking out of two key figures, both from Hamas and Hezbollah this week. Now, separately, in comments overnight, President Biden was speaking to reporters in Maryland after the exchange of the political prisoners, and he was asked about how the Middle East and the ceasefire discussions are going. This is new. He was saying we have the basis for a ceasefire. Netanyahu should move on it, and they should move on it now. So again, the U.S. pushing very hard to get this ceasefire agreement across the line. One of the key stumbling blocks, of course, is that Israel has been hesitant to sign on to a truce that would lead to a permanent ceasefire. And at the same time, a lot of questions are being raised about who actually is going to be representing Hamas on the other side, given two of their senior commanders' figures have been taken out in the course of the last few weeks.
Yeah, absolutely, and quite incredible to think about progress being made in the context of those assassinations. Talk to us about the role of Hezbollah here then. Hezbollah's leader has threatened Israel, saying the conflict has entered a new phase, but some people drawing attention to the fact that he's not calling for all-out war at this point. Is that something getting attention in the region, Jemana?
It is, absolutely. And I think many people were on alert for what Hassan Nasrallah, the leader of Hezbollah, had to say yesterday. He spoke via video at the funeral procession of Fuad Shukr, who was, of course, his right-hand man and the commander that the Israeli airstrike took out on Tuesday evening. And the language was a lot of fighting talk. He warned of a potential retaliation. But again, as ever, with these types of speeches that Nasrallah tends to deliver, he kept it vague. He said that the retaliation will be very well studied and not superficial. But he did say that the war has entered into a new phase that is different from the previous periods. And again, here, the diplomatic channels are working very hard to stop Lebanon from being dragged into a war, a bigger war in the region, similar to what happened in 2006, which brought on a lot of destruction on the country. At the same time, another funeral procession was being held in Iran yesterday for the death of Ismail Haniyeh. The Ayatollah, the supreme leader, led prayers there, and he himself, the Ayatollah, has vowed retaliation on the attacks earlier this week. So still, the region is on alert for these anticipated retaliation, but we don't have any idea yet what form they're going to take.
Jumana, thank you very much. Bloomberg Horizon's Middle East and Africa anchor, Jumana Besetcha, with that update on the Middle East. In other geopolitical developments, of course, the Wall Street Journal reporter Evan Gershkovich is back in the United States after being freed in the biggest prisoner exchange between Russia and the West in decades. Gershkovich was released along with former Marine Paul Whelan and another journalist with dual Russian and U.S. citizenship. The president and vice president greeted them as they arrived at Joint Base Andrews.
Toughest call on this one for other countries, because I asked them to do some things that were against their immediate self-interest, and really very difficult for them to do, particularly Germany and Slovenia. Slovenia came in at the last minute, and I tell you what, the chancellor was incredible. I don't buy this idea that you're going to let these people rot in jail because other people may be captured.
This is just an extraordinary testament to the importance of having a president who understands the power of diplomacy.
Let's bring another voice into this conversation. Laurie Bristow served as the UK's ambassador to Russia from 2016 to 2020, and I'm pleased to say he joins us now. Former ambassador, very good to speak to you. Thank you for joining us. I wonder if you can tell us something about the extent of work that would have gone into putting something like this together, involved so many countries, and at such a difficult time in broader US-Russia relations. This must have been a sort of epic piece of diplomacy.
Yeah, well, I think the first thing to say is just how delighted everybody will be to see Evan Gershkovich and Vladimir Kara-Murza and the other people released by Russia yesterday back home. I mean, they should never have been taken in the first place. And I think that's a really big achievement for the Biden administration. I mean, clearly, the negotiating this kind of deal, it takes a very, very long time. I think it was in the works for several years in different forms. And of course, these things are very, very sensitive, very high risk. And I mean, something can go wrong right up until the very last minute. And of course, when you're dealing with the Kremlin, you never take anything at all on trust. The other point that we just heard President Biden make was the extreme complexity of the diplomacy around this. I mean, asking the Germans to give up a murderer, an assassin who was sent to Berlin by the Kremlin to kill somebody. That's a really big ask. And I think that's, again, a great credit to all concerned to manage to put that deal together.
Yes, I mean, where does that particularly what you said there at the end then about who was released by Germany, where does that leave Putin? Does this leave him claiming that this is a big victory for him?
Yeah. Well, first of all, I mean, clearly this wasn't an exchange of like for like. It wasn't an exchange of political prisoners on both sides. It wasn't an exchange of spies on both sides. Mr. Putin got back an assassin, some spies and some criminals. The rest of us, the free world, got back some journalists, some human rights activists, some political leaders, as I said, none of whom should have been detained in the first place. I think Mr. Putin will be feeling pretty happy with the outcome this morning. You'll have seen him on the tarmac in Moscow last night greeting his people coming home. Stark contrast with the greetings on the tarmac in Andrews Air Force Base. I think that tells us all that we need to know about the nature of the regime in Russia, that the president of Russia would go out to meet these people and see this as a triumph.
What about the wider story here about US-Russia relations, Laurie? Does this tell us anything about the wider story? Because relations are extremely strained. The US is supplying a country that Russia is currently fighting in Ukraine. What does this tell us then about those relations?
I don't think, as far as the war in Ukraine, or Russia's war against Ukraine is concerned, I don't think it tells us anything at all. This is, I think, a freestanding deal, to get out people that both sides needed to get out and bring back home. As far as the war against Ukraine is concerned, nearly 900 days in, I don't see any sign that Mr. Putin is changing his fundamental objectives here. Russia isn't making serious breakthroughs on the battlefield. It's struggling to replace huge losses. Its economy is looking increasingly bad. But there is no sign of a rethink in the Kremlin. Russia is still attacking Ukraine every day. So I think for the rest of this year, what we'll continue to see is very, very high-intensity warfare taking place in Ukraine, killing lots of Ukrainians, causing enormous amounts of damage. The question is, of course, out there in due course as to whether there's a negotiation to be had to bring this war to a close. But I don't see this particular exchange having any bearing on that.
For those outside diplomatic circles, former ambassador, it always seems quite strange that prisoner swaps can happen almost devoid from the broader context of a relationship. And maybe we see this in many spheres, not just between Russia and the United States. I suppose it doesn't surprise you that this kind of diplomacy is possible, even when relations are so strained?
It is possible as long as both sides are looking for a deal and both sides have something to trade. Now, there, I think, lies the dilemma, really, for the United States, the UK and others. There's something that sticks in the throat about giving back to a regime like Mr. Putin's. People like Krasikov, the killer who was caught in Berlin and sent to prison for murdering somebody in Berlin, in exchange for journalists and human rights activists. We have some experience of this in the UK, when the Russian state sent somebody to kill Alexander Litvinenko in London in 2006, and they tried the same thing again with a former GRU agent, Sergei Skripal, when I was ambassador in Moscow in 2018. So there is that dilemma in there about whether you trade people in these kinds of circumstances. But I think for today, I think everybody will just be very, very happy that those people are back home and safe.
Away from the prisoner swap and back to the broader context between the US and Russia, we are going to be fast getting into it. Well, we are in an election campaign in the United States, and soon we'll know exactly who are the candidates, but we think we have a good understanding. Certainly Trump is, and probably Harris. How do you think Russia will be viewing the possible arrival of a Trump 2.0, Trump second presidency?
Well, I think probably until a couple of weeks ago, Putin was probably counting on there being a second Trump presidency. I mean, the poll figures were saying what they were saying. Of course, Mr. Biden's decision not to seek a second term, will have thrown that calculation, if that's what it was, into some disarray in Russia. But I don't think that there's been a sense in Russia for some time that a Trump presidency would give Mr. Putin everything that he wants, particularly in regard to the war in Ukraine. I think we're in a rather different position from what we were in at the time of the 2020 election.
You do. So, I mean, there's been a broad assumption that President Trump would try to bring this to an end and that might mean Ukraine giving up some territory. Would you expect it to develop in that fashion? Of course, we might end up with a Harris presidency, but if we did see Trump in power?
I think regardless of who's in the White House, and the focus, through the rest of this year for Ukraine and its backers, as well as for Russia, will be turning to the question, how do we want this to end? How do we think this ends? I personally don't see that there is a clear-cut path to military victory for either Russia or Ukraine from here. Of course, it depends how you define victory. At the moment, I don't actually even see that there's a negotiation to be had with Mr. Putin's Russia because, as we all know from bitter experience, negotiating with the Kremlin, for example, a ceasefire, it doesn't mean the actual ceasing of fire. This is what happened in 2014 and again in 2008 in Georgia. What the Kremlin will be looking to do there is to reset to its advantage to hope that the Ukraine's Western backers will lose interest and withdraw support from Ukraine, and then Russia gets another go at imposing its will on Ukraine. That, for us, I think, is the heart of any negotiation, to make sure that Russia never again does what it did in 2022 to Ukraine.
Thank you very much. Former UK Ambassador to Russia, Laurie Bristow, thank you very much for your time this morning. Coming up, the Bank of England Governor tells us what he's looking for before making another interest rate cut. We'll bring you our interview with Andrew Bailey next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Welcome back. This is The Pulse. I'm Anna Edwards in for Francine Lacroix. Now, the Bank of England governor says the UK's key policy rate won't go back to near zero after the BOE cut it yesterday for the first time since the pandemic. Speaking to Bloomberg's Francine Lacroix, Andrew Bailey explains what policymakers are looking for before making more cuts.
Well, we were looking for, in a sense, for sort of confirmatory evidence. We weren't looking for something to change necessarily. It was confirmatory evidence. We had that. I think we had, certainly in my own view, is we had that. But we will be looking at this framework and saying, are we seeing this sort of rather more benign comp process which we can sort of further confirm? Or does this sort of structural issue, which is why we've put this sort of risk in, that maybe COVID, for instance, has changed some elements of the structure of the economy, which is going to make the thing more sort of resistant, if you like, to measures to get inflation down. And that's the judgment we will have to keep coming back to.
Where do you think rates settle? Is 4% restrictive?
We don't have a number on it. What I would say is this. I think it's reasonable. Don't expect we're going back to zero, because zero was the product of huge global shocks, starting with the financial crisis, then obviously COVID as well. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it will be lower than where we are today, but I think it's very clear that we're not going back to zero.
Governor, the government has said it will borrow an extra £16 billion this year. Does that change the calculus around rates?
Well, I'm going to wait for the budgets on the 30th of October to see the full picture, because we always condition on an announced fiscal policy. That's what we will see at the end of October, and we'll sort of put it through the machinery at that point.
So the Fed, the ECB, the BOJ are all adjusting policy, and that's very clear, and it's changing some big change in foreign exchange markets. What are those, what of those elements are actually important to you and BOE policy?
Well, we obviously don't have any target for the exchange rate. That's all a long way in the past in terms of that sort of thinking. But obviously, the exchange rate feeds through in terms of financial conditions. We've seen some appreciation of sterling since we did the last report and forecast in May. Sterling has appreciated. We fed that through, as it were, so it changes import prices and so on. And that's how we tend to look at it, actually. I would say recently, over the last four or 5 years, actually, in the sort of transmission of mechanism of monetary policy, exchange rates have not played a very large role. And I think the reason for that is because we've all been facing essentially global shocks. So these are not sort of specific shocks that affect one central bank but not another. We're all in the same place, really.
The Bank of England Governor Andrew Bailey there speaking to Bloomberg's Francine Lacroix. Coming up, we'll dive into some corporate news flow. IAG pulls back on a takeover that would have expanded its reach further into Spain. We will have the details next. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Welcome back. IAG shares are up about 5% this morning after British Airways parent company abandoned plans to buy Air Europa for a second time. The group reported revenues of 8.3 billion euros in the second quarter, meeting analyst expectations. Let's bring in Bloomberg's global aviation editorial leader, Benedict Camel, who can give us more details. Not a bad achievement to just have your share price going higher on a day like today, Benny. But what sort of concessions then, back to this particular story, what sort of concessions were offered on Air Europa? And what does this say about consolidation in Europe, the fact that this is not going to happen?
Yeah, so quite a lot to get through on IAG last night. They came out with 3 separate releases. The first one was that they would reinstate a dividend. Then they said they would drop the Air Europa deal. And then they came out with the earnings, which you've just highlighted. And it was, some good news, some bad news. The bad news for IAG, at least, was that they, for a second time, failed with the Air Europa deal. They said, we came to a point where we just felt it wasn't commercially viable anymore. The concessions that we made were as far as we could push it. The EU regulators wanted more, and we sort of came to a point where we felt it wouldn't make any sense to throw even more into the ring and see if we could get it over the line. So we ended up pulling the plug on this one. Sort of cold comfort for investors is the fact that they are reinstating the dividend and that the numbers were actually fairly good in terms of earnings. The deal was never that popular among analysts and investors, given that IAG has fairly high debt, and there was a concern that, is this really necessary to pile on even more? So there might be a little bit of relief on that side as well that has now fallen through again.
And what were some of the results that IAG announced last night then, Benny? How's that been digested?
Actually, fairly well. I mean, they're sort of the last company to report among the big European airlines. We had Lufthansa, we had Air France, and Lufthansa in particular had a very sort of poor set of numbers. They had downgraded their outlook a couple of weeks ago, and the numbers that came through a couple of days as the final set weren't that great either, sort of a muted outlook. We've talked a fair bit about sort of the sense of revenge travel, if you can call it that, has sort of come to an end. IAG, and in particular British Airways, which is part of the IAG group, they have the transatlantic business, which is very strong. They also own Iberia, which is obviously big into the Latin American market. So they always have these routes across the Atlantic that are helping them, and you could see that feed through the numbers yesterday.
Benny, thanks very much. Bloomberg's global aviation editorial lead, Benedict Camel, with the latest on that story, that M&A that is perhaps not going to come to pass after all. Let's talk about where we are on the pre-market in the United States. I can tell you that broadly, E-minis are down by 0.9%. NASDAQ futures down by 1.6%. So there's a great deal of weakness, and some of that is focused on the technology sector. You can see the Intel pre-market share price telling you what you need to know about how the market feels about the numbers we got from Intel yesterday, the dividend cut and the numbers they reported. Amazon faring a little better, but not by much. That stock down by 8.4%. The broader story here in Europe is worry about tech, worry about the US, though. Stock 600 down by 1.3%. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. Welcome to Bloomberg Brief. Let's set the agenda.
A weak U.S. data delivers a growth scare to global equity markets. 10-year yields falls below 4% for the first time in months. Mag 7 and chip stocks bear the weight of the sell-off, wounded by disappointing earnings from Amazon and Intel. The focus now turns to the U.S. jobs report. Will the unemployment rate hold steady? Good morning, Manus.
Danny, a very good morning. The question you need to ask yourself, we are swinging around by $100 billion a day on NVIDIA and more. Was yesterday's move cathartic or the beginning of a much more significant crisis of confidence in equity market? Either way, the Russell dropped by 3%. The NASDAQ was under considerable pressure. We have the eye of a growth scare and policy area. You're going to hear these phrases throughout the day. We'll talk about them with guests. The equity bears were given plenty to feed on. The tech sector, look at Intel, down 21% now. 15% of the workforce will go. Cuts in the dividend will go. Is it idiosyncratic to Intel or something more malevolent about the growth narrative within those stocks? You're going to hear people now saying that Powell is behind the curve, the Fed is behind the curve, we're in policy error. There is also going to be a rising clarion call about what happens, perhaps even intermediate. I know you and I laughed about that, but you know what? Stranger things have happened. The bond market's significantly below 4%. It's a 7-day winning streak for the bond bulls. You haven't seen that since 2020 in the eye of the pandemic. You're looking at twos at the lowest in 14 months, and now the swaps market's pricing 3 cuts. And as I say, there's just a tiny, tiny, tiny pricing of an intra-Fed cut. I know it's a high spec, but we'll throw it out there. And when you want to understand the real demolition in confidence, when a currency goes bid, look at the Nikkei. This is some of the biggest moves in the Asian trade. The topic's the biggest move down since 2011. So you are looking at yen strength and a tech sell-off, which is malevolent in Japan.
You do get the feeling that something has changed. Something has become unglued. And the big change is that this is off the back of weak data, that you saw small cap sell off the back of weak data. Because previously, Manus, it had been data is weak, bad news is good news because it means that we'll be getting Fed cuts. So is this a paradigm shift where equity markets now need to price in a harder landing and we can't all cheer by the fact that cuts are coming?
No, the one thing that I didn't even say when I was doing the market check is, by the way, we have got a jobs report today, 175,000. There is a consensus out there that this could be, as you said, look, what do you get today? You get some kind of confirmation bias that we are really in a growth scare or not, as the case may be. And as I say, I will put it to you out there now, which is you're going to hear people talking about a 50 basis point cut in September and If Drax are to be believed on the IB at the moment, the market is currently pricing the nano risk of an intra-meeting cut.
See, this is the thing.
I love that.
No, but it's so interesting because Powell was so calm and collected during his press conference. You had a situation where the journalists questioning him were more dovish than Powell himself. Yeah. And yet you have people betting for an intra-meeting cut. It's
not. No, I've really got to emphasize this. It's so nano. Okay.
It's small, but bonds are still rallying today into a jobs report where it's clear the risk is asymmetric given that big rally for it to, disappoint, not to give the bears what they want. Okay, so we also had tech earnings in the midst of all of this. So much to go through. Apple had upbeat outlook, standing out from the crowd despite sluggish China revenue. CEO Tim Cook does continue to be optimistic, and there is growth in the market, he says. Here's him on the earnings call.
During the quarter, I should say also that iPad returned to growth in Greater China as it did around the world. And so we continue to be confident in the long-term opportunity in China. I don't know how every chapter of the book reads, but we're very confident in the long term.
Let's get to Bloomberg's Tom McKenzie. Tom, where do you want to start? We have a lot of earnings, Apple, Amazon, Intel. Take your pick.
Well, look, we'll start with Apple, but look, as you guys were discussing, and we talked about this before these crucial tech earnings, what investors wanted to see was a clarion call of clarity from these tech executives that the growth was there, that investments around AI are paying off, and that they can drive upside in terms of margins. And what you've seen is a much more nuanced picture. Let's start with Apple then. The downside in terms of the China market, that was the fly in the ointment for an otherwise better picture from this company. They got growth of 5%. They've had 5 previous quarters, 5 out of 6 where they've missed. Revenues are back for Apple, growth of 5%, and in the current quarter they're looking at similar growth as well, 5% above the estimates. But you saw that drop of 6.5% in that crucial Chinese market, where you've got a ban amongst state-owned enterprises in terms of their employees being able to use these devices, and of course increased competition, and a consumer, frankly, that is facing pressures from all fronts in China. But you heard it there from Tim Cook. He's still confident in that market, and he says a lot of this is down to strong dollar. They emphasize that. A lot of this is down to strong dollar. Going forward, they think there's strength coming through. They saw that iPad pick up in China. Also going forward, and a lot of this was forward-looking from Apple, the AI, so Apple Intelligence, that will drive this upgrade cycle. That's what you heard from executives. That gets launched, the iPhone 16 in September, then you get the AI pieces being put to play in terms of the upgrades in October, and they think that will lead to this upgrade cycle. The premium part of the smartphone market is still holding up relatively well. That's the bright spot looking forward for Apple.
You can imagine the Trump team being very happy with that now. It's even Apple talking about a strong dollar that's killing their numbers. Pat Gelsinger makes it very, very clear. I have no illusions that the path in front of us will not be easy. Some of the most consequential changes in our company's history. Intel could well be said to be idiosyncratic, but Intel and Amazon are both going through a lot of change. What do you think the most important takeaway for you was from Intel? It's being bruised again this morning.
I like the fact that you make a point of saying that this is an idiosyncratic story for Intel, because a big part of what's happening in Intel is that idiosyncratic story, playing that catch-up game to the likes of NVIDIA and AMD in terms of those GPUs and artificial intelligence. They have a play in that in terms of developing AI chips for laptops and for smartphones, but that is still a ways off. They're spending very heavily on these foundries. They want to be competing with the likes of TSMC. That is coming at a huge cost. It was a brutal set of numbers from Intel, cutting a dividend that they've had in place since 1992, cutting 15,000 jobs, and projecting out softer earnings than analysts had expected.
Yeah, it certainly was brutal, to say the least. Tom, thank you very much. Tom McKenzie on the tech earnings. Our guest this morning is Alison Porter, Portfolio Manager at Janus Henderson. Alison, it's been a frenetic 24 hours. It's been a frenetic 5 days, or a month, as Danny said, when she came in and sat down this morning. Do you feel that in tech, we're at some kind of a pivot point of where the patience is going to really be tested in terms of the delivery on AI? Good morning.
Good morning. No, I think, if we went back to last summer, we had a very similar situation. We saw a tech sell-off, including NVIDIA, down double digits, and that's really consistent with what we see in these waves of technology. So I think just now you've obviously got concerns about where we are in the economic cycle, people worried and saying, be careful what you wish for, because we're getting close to a rate cut. Is that because the economy is slowing? But then for the technology stocks, we also have this fourth wave of technology moving into AI. And just as we saw both in the second wave for PCs and in the mobile internet wave, it accelerates returns for technology stocks, but also it can accelerate volatility. And in the 6 years of the mobile internet wave, we saw double-digit returns, but also a double-digit pullback within those years. And even last year, were a very strong year for technology. Over the summer period, we saw this double-digit pullback as investors continue to reappraise spending and returns. And I think we've seen evidence from Amazon, from Microsoft, from Google, and particularly Meta, of the types of returns that you see in some of the AI infrastructure spend that they have. But this is a long time, still early in that cycle.
Well, Alison, to that point, just to go through some of the numbers, Meta, they said that CapEx spending will be as much as $40 billion. Microsoft said $55.7 billion this year. Amazon said it will be more than $60 billion this year. What distinguishes between responsible spending and irresponsible spending on CapEx at this point?
So it's dependent on what return these companies can derive from this over the longer term. You saw in the case of Alphabet, their search business year on year is going to add $20 billion this year. In prior years, even pre-pandemic, it's been adding between $12 and $14 billion. That's a major step up. You see in Meta an acceleration in their engagement with users in pricing and volumes. So again, really seeing the payoff for that early AI investment that they have made. So, these investment phases are long. As we saw during the mobile internet phase and PC internet, advertising tends to be one of the areas that benefits first. And we definitely saw that in Google's search business and in Meta. At Microsoft and at in AWS and Amazon's cloud business, we saw a significant acceleration there from Amazon, up over 19%. And whilst there might be a focus on some of the operating income and the CapEx, I think just remember this business is now, over $100 billion. And whilst it's only 17% of Amazon's revenues, it's actually over 60% of their operating income. And margins are, significantly better than anywhere else in the business. And that's driving really strong returns on that AI CapEx spend that we think is still in very early stages.
If you had to make a call in terms of who is winning in the AI race, if you look at the AWS within Amazon, the cloud business within Amazon, sales up 19%, that's a very comfortable beat. Microsoft said, look, we haven't got the capacity to meet demand. So I'm curious to know who's winning in that space and whose strategy do you bank on more?
So, AI has multiple layers and there will be different winners in each of the layers. In terms of cloud infrastructure, we've got 3 clear winners in Microsoft, Alphabet, and AWS. And we think, they're all carving out niches within that. And the market's more than big enough. It's not a winner takes all. There won't just be one cloud winner. And we think that that shift to the cloud is still in early stages. And all 3 of those companies will perform well. AWS has an open source strategy. Obviously, Microsoft and Google both have their own large language models that they're developing. But we think that all 3 will continue to do well as many organizations will move to multi-cloud. And then you also have Meta that has the distribution that can really help it drive Meta AI, its assistant development, and those advertising dollars. And as we've seen before, it takes a long time to see new winners in applications emerge, and we think that will emerge over the next 3 to 5 years.
Well, I'll tell you what, when you look at Amazon down 8.7 pre-market, you get the feeling that investors aren't willing to extend that patience to them. Alison, I'm afraid that's all we have time for. Thanks for joining us this morning. Alison Porter of Janus Henderson. Okay, Manus, let's get to some of the other top stories trending on the terminal this morning. BNP Paribas is in exclusive talks with AXA to buy the insurer's asset management unit. It would be for $5.5 billion. It's set to create one of Europe's largest money managers with about $1.5 trillion in assets under management.
Warren Buffett sold shares in Bank of America for the 12th straight day. A massive stake in the lender by a total of 8.8%, amounting to $3.8 billion since mid-July. So far, Berkshire Hathaway has kept silent about its reasoning behind the whittling down of their holding.
And an influential Chinese central bank advisor urged his government to set compulsory targets for inflation and step up spending to address weak consumption. The rare critique from a monetary policy committee member also highlighted that focusing on investment and neglecting consumption was out of step with the weaker demand that now defines the economy. And Manus, we track a sell-off this morning that is still ongoing.
It is indeed. S&P down 1% at this stage. What belies underneath that are things like Intel down 21% pre-market. NVIDIA, it's a small sell-off, relatively speaking, down 3.6%. So the tech, but then of course it was Russell that took the real basting yesterday.
Yeah, Russell down some 3% yesterday. Semis down 7% after a day when they were up 7% on Wednesday. It is an equity market that is giving some serious whiplash.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's your Bloomberg Brief, Danny Berger and Manish Cranny in New York. So oil is headed for its longest streak of weekly decline since December. With that latest geopolitical tension, though, means that oil prices are indeed rising this morning. Joining us now is Bloomberg Executive Editor Will Kennedy. Will, sure, oil sold off yesterday some 2%, but the day before that it was up 4%, and today it's up more than 0.5%. What do you make of oil not necessarily participating in this growth scare that's capturing the rest of markets?
I think the growth scare is there. I think when you talk to people in the market, they are worried about China demand in particular coming through very weakly and not seeing the growth that you would expect in oil demand, typically from China, which for decades has been a huge driver of demand. But I think what's different with oil is you have got these geopolitical tensions, worry about the potential for escalation in the crisis between Israel and Iran, and what that could potentially do to disrupt supply. Now, it hasn't impacted oil supply yet, and it would be a pretty extreme scenario that did interrupt oil supply. But it is a worry that's there for traders, and I think as you go into weekend, that's probably why people don't want to be too short.
Yeah, I think it's going to be interesting to see the Iran response mechanism and just how high that is. Will, we're counting down to Chevron and Exxon. The idiosyncrasies of these two stories, one is about a major M&A deal, which is extend and pretend Chevron has, and the other one is about refining margins. How do you think the market is going to look at these two as a narrative for the end of 2024?
Well, clearly we saw quite a big sell-off in Chevron yesterday on this news that the arbitration for its Hess takeover, which is a takeover that clearly investors would like to see, was delayed until spring next year. People had hoped that that would be resolved this quarter by the end of this year. So I think they'll want to hear today what they have to say about that. As to the broader picture for both companies, I think they'll, as we saw with Shell yesterday, report steady earnings driven by these relatively high oil prices. Yes, the refining businesses, and that's a very big business for Exxon in particular, will take a hit. But the consensus is that it will be broadly in line with what we've seen before, and they will continue to return cash to shareholders at the rate they have been. The other thing that people always look at with these two companies these days is how they're performing in the US. They've both built up big businesses in the Permian Basin, that very important field that drives oil supply for the US and the globe, to see how the outlook for supply is there.
Okay, well, thank you very much. Let's see what those numbers are. And as you say, a big issue on this arbitration on Chevron Hess. Hell of a lot of money at risk there. And tune in, we've got the interviews for you lined up here on Bloomberg. The Chevron CEO, Mike Wirth, joins the team at 10 a.m. Eastern time. It's worth just checking back in on these markets. Interesting how, geopolitics is perhaps giving a little bit of a floor to some of that oil market, but these equity markets are under pressure. Now, the question is this: do you get a confirmation bias in the jobs report? I think that you've got a growth scare which is escalating. Fed behind the curve is the narrative. You get your jobs report today. Does that add injury to this kind of sell-off in the equity market?
In order to really get this equity market sell-off going, you'd have to argue that we're going to get something other than a soft landing. Michael Hartnett from Bank of America with his note out today saying to sell the first cut because there is a hard landing that is not being priced in. But the risks are so asymmetric, Manus. We've been selling off in equities into this jobs report. We've been buying bonds. We're doing both of that this morning. We are long bonds at a time when already 150 basis points of cuts are priced in over the next 12 months. How much more room is there really to price in more? Are we not already priced to perfection?
It depends whether you get this move higher in the unemployment rate. The one thing that has been the holy grail within the Fed narrative and the soft landing is that the unemployment, yes, it has risen. It has risen from 3.6% to 4.1%. The next thing is, Danny and I will be talking about the SAM rule. Danny will tell you that Claudia Sam herself says don't bank too much on it. And then you get every economist and their wife and their husband come along saying, yes, the SAM rule, unemployment has risen by 0.5%. It's time to cut. The question is whether they actually do something larger. And I think it's a significant discussion to have. May they be pushed into doing something larger in September than we think at the moment?
Well, you know who also doesn't care about the SAM rule?
Go on then.
Jay Powell. He said it in the press conference. It means nothing to him. Same with the inverted yield curve. Okay, coming up, we're going to take a look at what's making headlines around the world here on your Bloomberg Brief.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself. I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's your Jobs Day edition of Bloomberg Brief. I'm Manus Grenny alongside Danny Berger. Let's see what's making the front pages around the world. And first up on the front pages, we have the images of Evan Erskine arriving home here in the United States yesterday. And it really was a hero's welcome, wasn't it, Danny? The images, very, very potent. His freedom came as part of the largest prisoner swamp between the East and the West since the Cold War. 16 were released in Russia in exchange for 8 Russian prisoners, including hackers, alleged spies, and convicted murderers.
I really recommend reading the journal story on this. It ends by saying that Gershkovich, his last act as a prisoner, was writing a letter to Putin asking for an interview. Okay, next up on the New York Times, Pennsylvania Governor Josh Shapiro, a potential VP pick for Vice President Harris, has canceled his weekend's fundraisers. Now, it's not totally clear what this means for the VP race, but Harris had told top contenders to limit their travel before her decision next week.
And Japanese stocks suffering their biggest fall since 2020. Now, this was driven, we've got the global sell-off here, global growth scare here. You've also got that strengthening in yen. I mean, there's fuel. There's the double punch for the Japanese markets, really, isn't it? In points terms, you're looking at some of the biggest moves since 2000. In percentage terms, it's some of the biggest moves since 2020.
And you have to remember that just in Asia stocks in general, Japan is one of the most liquid. So if you are having this scare and you're thinking, what of my portfolio can I sell? Japan is kind of an easy target. It's more liquid than the Chinese markets, the other South Asian markets. So you might be seeing just some of that technical factor going into the Japanese market too.
I think also this sort of the alpha that we saw in dollar yen, there's dollar yen 148.95, and there is this narrative that you potentially can trade down to 140. And what if you get a softer Fed? That really is going to add to that. In terms of the actual closes, this is what we've got for you. Topics down 6% and the Nikkei down 5.8%. Of course, banks and tech are huge pieces of that particular market.
I'd say probably the only person that's really excited about today's market moves is Governor Ueda, because it does help strengthen the yen, and especially if we get a weaker job support, it will do the same too, Manus.
Indeed. But the concentration risk is, look at that, the DAX is the tech-heavy aspect of Europe. European stocks down 1.5%. We're counting down to payrolls with Citi's Veronica next.
Also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, I'm Danny Berger alongside Manus Granny. Let's set your agenda.
Weak U.S. data delivers a growth scare to global equity markets. 10-year yields fall below 4%. Mag 7 and chip stocks bear the weight of the sell-off, wounded by disappointing earnings from Amazon and Intel. And the focus now turns to the U.S. jobs report. Will the unemployment rate hold steady as she goes?
Man, what an August it's been, and it's August 2nd. You get that feeling that the days are really stretching out. You have an equity market sell-off and a bond market rally that is continuing in force today. That is notable that we're carrying it through more than 24 hours. S&P 500 futures fall by more than 1%. NASDAQ leads some of those declines with really bad numbers from Intel. Intel down more than 20% this morning. NASDAQ down nearly 2%. Russell 2000, you can see on the bottom of your screen, that is also underperforming, down 2%. Because it is a growth scare that's happening in tandem with the concerns about tech earnings. You had the ISM numbers and some of the jobs data coming in concerning. So as you say, Manus, this jobs data is crucially important. 10-year yield, that is below 4% for the first time since February. 3.9% is where we stand. Goldman Sachs, Manus, says that if you thought this earnings season was volatile, it's not just in your mind. The average stock has moved 5% after reporting its earnings. That is the most on record.
And you are having $100 billion days swing around on the likes of NVIDIA, nearly $400 billion just the other day, Danny. So in terms of if the hedge funds have gone to the Hamptons, they've left a little bit of volatility on the table. I mean, there's no doubt about it. You know, how much credence do you put on the manufacturing data, you know, versus the NASDAQ? The NASDAQ is not manufacturing. Manufacturing is not services. Inflation, everybody. That's what you're supposed to be focused on. There you
and
go.
It's delivering life lessons on a Friday morning. No, but look, it's this idea that the only place this market has to go is to price in a hard landing. Michael Hartnett, Bank of America, saying sell the first cut, that a hard landing needs to be priced in, and it's underappreciated.
Look, I think what you're going to get between now and the next Fed meeting, because you do have two more inflation prints, etc., 2 more ratification points, is you're going to get this swing factor between they're going to go 50 basis points. No, they're going to go 25 slow and steady. They may even go for an intermediate cut. No, that's not going to happen, because this market needs to be so preached to and so converted to and so told that they couldn't handle an intermediate cut.
It's been a year that what's worked really well is just fading all the extremes. Fading the extreme of 6 cuts, fading the extreme of no cuts, and maybe now fading the extreme of a hard landing.
There you go. There's a distance between now and a hard landing. Mike McKee joins us around the desk this morning to discuss the jobs report. So, look, Danny and I are talking about these numbers. The jobs number in of itself could be a heck of a confirmation bias to the ruckus that we've had this week. If it's weak.
It could, because we've gotten some bad preliminary jobs numbers this week that have really scared people. But when you look at the forecast, 175,000 for the month of July, and that's basically in line with forecasts for the last 6 or 7 months. And in 5 of the last 6 months, the jobs number, establishment numbers come in higher than the forecast. So if you're trading patterns, you might go with that and have a better day. Unemployment is going to be really interesting, and you know why. 4.1%, what we're talking about. Manufacturing jobs, we had that bad ISM number, and earnings could be affected by the hurricane down in Texas because earnings and hours are going to be more affected than the number of jobs. But the SOM rule is what everybody's going to be talking about, and whether or not we get high enough unemployment to trigger the SOM rule. It's going to take about 4.28%, I think, to get there.
I know. It's the rounding that kills me.
It's the rounding that kills you.
Because you know, Mike, there's going to be people who look at 4.2% and say, that's close enough. We're basically there.
If you want to panic, there's certainly the opportunity. But the interesting thing, and this is what you guys were just talking about, is yesterday we saw that bad ISM manufacturing number, and Tim Fiore, who runs the survey for ISM, said this: demand remains subdued as companies show an unwillingness to invest in capital and inventory due to current federal monetary policy and other conditions. Also yesterday, the governor of Illinois came out and blamed the Fed, saying high interest rates were causing layoffs at companies in his state. So there is a feeling growing out there that the Fed may be a little bit offsides. And if we see a bad number today, then you're going to get that kind of reaction in the markets.
Yep. All right. Well, I'm going to hold on to my seat for one. Mike, thanks so much for joining us, Michael McKee. And tune in at 9 a.m. Eastern. We're going to have our interview with Acting Labor Secretary Julie Su after those numbers come out 30 minutes before. Okay, joining us to continue the conversation is Veronica Clark, U.S. economist at Citi. Veronica, can I first say you just get huge kudos for talking about the weakness in the economy when this market was just seeing sunny skies. And now the market has come down to you. So first of all, congratulations for sticking to your guns. Second, is there any jobs number that we could see today that would mean 50 basis points cut is in contention for September?
Yeah, it does seem like that bar for a 50 basis point cut is getting lower and lower. We have had a string of consistently strong headline payrolls numbers, headline jobs growth. I think we'll see similar today. We're expecting 150K. That's still very healthy. Maybe anything around 50K, well below 100. But I think those headline jobs numbers have actually gotten maybe increasingly misleading. We're more focused on the unemployment rate, of course, and that's come up pretty consistently. We do think that comes up again today, not quite triggering that SOM rule, but something around 4.2%, and that definitely gets the market more worried.
Look, I know we were having a little bit of a joke before we came back on air, which is, how important is the SOM rule for you? Danny reminded me earlier in the week, Claudia Sam herself has said, look, by all means, it's relevant, but don't overuse it or abuse it. You're in the market and you're trying to advise clients. So how pressing is it for the market?
Yeah, the actual triggering of that, half a percentage point increase from the low of the last 3 months on a 3-month moving basis, is that exact contour, exactly right? I don't think necessarily. Powell called it a statistical regularity this week, so he's maybe not putting his full weight behind it.
Sure.
But this idea that we do in a usual cycle see a very gradual weakening of the labor market before you reach a point where things can accelerate and weaken much faster. I think that's still true, and that is kind of where we're right on the brink of now.
Because I wonder, what in the numbers do you need to see to say, okay, this is not a supply thing. This is not just more people coming into the country. This is a demand thing and layoffs are happening.
Yeah, I mean, in a sense, the increase in the unemployment rate really hasn't reflected the increase in supply. There's not been an increase in labor force participation or in population in the household survey. So it is reflecting that people have lost jobs. And when you do lose your job in a normal, that's a normal way of life, it's been really hard to find a new one. Hiring has really pulled back. We saw that in the JOLTS report earlier this week, another drop in the hiring rate. What we don't see yet, which would be almost too late if we do start to see it, are the big layoffs. That's the non-linearity of a weakening labor market. It can quickly build on itself. It's not that we don't see no signs of building layoffs. We have had an increase in initial continuing jobless claims, even some of the details of the last jobs report. But that's still where there's maybe some hope for the labor market.
well, certainly the hiring part of the manufacturing data yesterday was more worrying, perhaps in conjunction with the jobless claims at a one-year high. So let's move it forward. Let's take the angst that we've had, where we've got a growth scare. The Fed is behind the curve theoretically at the moment. If the rest of the data compounds and adds to this, what does that do to the narrative we've been talking about? Oh, it's a tweak. Oh, it'll be a tweak. Oh, there'll only be a tweak. 25 basis points. Now we're at 3 cuts. Okay, and if this data does get worse, then suddenly the debate about where our star is becomes a lot more prescient and potentially lower than where the market is coalescing around at the moment.
Yeah, I think in those initial first cuts, we still probably won't have the best, clearest idea of where the Fed will end up, how far rates will fall. Probably not to zero, right? This is probably not a 2008 kind of shock. We would think it's a more run-of-the-mill kind of recession.
Yep.
You cut to something around neutral, maybe a bit below. But yeah, what you can see is that maybe some of those cuts just really get more front-loaded. So you can see, starting with a 50, maybe a series of 50 basis point cuts. The Fed, of course, we're coming off a high inflation period. We will still be a bit, cognizant of, not stoking, maybe shelter inflation housing market too quickly. But yeah, this is going to be a Fed that's very quickly turning to trying to support the economy.
We haven't completely seen that yet, though, from the language. I mean, Powell and the other members of the FOMC have started to talk about weakness in the labor market, but they don't seem rushed. Powell was calm, cool, and collected despite all those journalists lobbying dovish questions at him. Does that worry you?
Yeah, I mean, in a sense, I think, when you do look at the data, and I think this is probably what Fed officials are trying to say, is, this is still a historically low unemployment rate. The level of, job growth, of the unemployment rate, of activity is all fine. I think for us, it's just that the trend has been consistently trending in a more concerning direction. So is it the level that's the right signal, or is it the trend that's the right signal? I would be a bit worried that it's more the trend.
The narrative has also been that corporates aren't in bad shape. I know we've had some tech earnings this week, which perhaps unseat our nerves. But households per se, we know they're bifurcated. At the lower end, there's pressure. They're becoming more diligent in terms of what they buy. But households are in pretty good shape overall. Corporates are in pretty good shape overall. So what is it that shifts us from soft landing to a hard landing?
Yeah, I mean, and there is a sense, households, you refinance your mortgage, your balance sheet looks a lot better, you pay down debts, similar for corporates. But I think it gets a little bit lost that, GDP is a flow. It's the marginal activity that you're doing. And for households especially, that's going to be really dependent on if you, have a job, if you feel like you have employment security. And we have seen household spending, pulling back in the last 6 months. Something like that could get businesses to, on the margin, cut labor costs a bit more and do that through layoffs, and that would be really what accelerates it.
Okay, Veronica, thanks for being with us. Pressing calls as ever. Let's see what the number is a little bit later on today. Veronica Clark of Citi. Checking in on these markets. We've talked about a growth scare several times through the morning, Danny. This is the equity markets. S&P futures down over 1%. The NASDAQ really taking the weight of this growth scare and reporting scare, I would say, in the NASDAQ rather than the growth scare, because Intel down over 20%, cutting 15% of the workforce, cutting the dividend, and various other big tech not exactly living up to the ambitions that have been set for them by the estimates.
Yeah, I'll tell you that Intel move is quite remarkable, but it was, some ugly earnings. Off the back of that, Treasury is also rallying this morning. Finally, the correlation is back to normal, maybe not in the fashion that people would hope when it's such a violent move, but bond markets are moving higher, yields lower. We're up by at least 2 basis points for your 10-year yield. We're below 4% for the first time since earlier this year. Just to give you a flavor of what's priced in. 3 cuts for this year, about 6 in total over the next 12 months. There are higher recessionary odds, you get the feeling, priced in here. That higher for longer narrative, that has been completely smashed. I thought Veronica Clark put it perfectly. It is the trend you should be worrying about, not necessarily the level of where we're at.
September's pricing more than 31 basis points cut, so slightly over the traditional quarter-of-a-point cut, and you're going to begin. There's even a small possibility out there of 50 basis point cut and an intra-Fed cut meeting. There you go. Why not have a fly in the ointment on that? Who knows? It's a punt.
Yeah, why not give the market 50 basis points from here on out? Okay, coming up, we're going to talk about that Intel double-digit plunge after their earnings.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's Bloomberg Brief with Manus Cranny and Danny Berger in New York, and it has been a brutal morning for global markets. Intel is in the eye of that storm, down over 20% pre-market, headed for its biggest drop in 24 years. This is on the earnings report. Tom McKenzie joins Danny and I now. Tom, the CEO was very, very clear, which is, you know, if you think the worst is past, buckle up, because this is going to be a bumpy ride. 15% of the workforce are to go, and that's for starters.
Yeah. Yeah, 15% equates to about 15,000 in terms of their headcount. They are scrapping a dividend that they've been paying since 1992. The stock is already down, Manus, 42% year to date. And then we see the moves that are being lined up for the session today. As you say, the biggest drop, arguably, if we get that, of course, in about 24 years. It's really challenging. For Intel, there isn't the growth driver that some of these other tech companies have that maybe offset some of your concerns in terms of the spend that's coming through as they try to build out the foundries part of the business. They have an expectation that maybe they can play in AI when it comes to laptops and smartphones, but they're not there yet. That's still some way off. And so that's where you see the challenge coming through. Jeffrey's saying that even the cost cuts that they're pushing through right now seem unlikely to solve any of the fundamental challenges Intel faces. In the current quarter, they flagged growth in terms of sales of 12.5 to 13.5 billion. Estimates had been for 14.4 billion. A pretty damning assessment from Jeffries.
It's honestly like a horror show of an earnings. I mean, to see something down 21%. Apple is only down about 0.2%, and in today's market, that might as well be up 20% because everything is falling really violently. What gave investors maybe less concern about Apple is some of these other tech stocks, Tom?
Apple has the future play as well, so they are also asking for patience. But Apple has the here and now in terms of the sales and particularly of smartphones, and that's turned around. So it's a decent quarter. Revenues coming in, the growth around revenues for Apple up 5%, and they're projecting the current quarter will be similar, around 5%, again above the estimates. They did say, hold on, because the AI theme is going to kick in later this year. They project an upgrade cycle for iPhones as consumers move to the iPhone 16 to take advantage of some of the software capabilities that will come through from October. The China business, yes, remains a concern for Apple. Sales there dropped 6.5%, but executives said a lot of that is down to dollar strength, and that long term, they still see that as a healthy market. Here's the take from Morgan Stanley. This was a clean quarter, say there, Anas, better services growth and record buybacks. Dan Ives saying AI is going to boost monetization, not just when it comes to hardware for Apple, but the software and the services as well.
Manus getting ready for his next upgrade. Tom, thank you so much, Tom McKenzie on tech. Okay, let's turn to Washington, D.C. Vice President Harris has raised a record $310 million in July. That's according to her campaign. That gives the presumptive Democratic nominee a cash advantage over Republican nominee Donald Trump. For more, let's bring in Bloomberg's Bill Ferries. Bill, it had been Trump outraising Biden when Biden was still the candidate. Now you have Harris bringing in what they say is grassroots money. What edge does that give Harris after the Democrats had been falling behind Trump?
Well, like you said, $310 million is just a massive haul in July. It's a record for this point in the campaign. And remember, Kamala Harris was not the de facto candidate for the Democrats until the third week of July. It was basically around July 21st that President Biden said he was stepping out of the race and handing it over or endorsing Kamala Harris as his successor. So $200 million of that was in 1 week. It's hard to believe that that kind of a pace can be sustained, but it has eliminated the gap that the Democrats and the Biden campaign at the start of July had with the Trump campaign. At this point, Kamala Harris and her campaign have about $50 million more cash on hand, $377 million for them versus about $327 million for former President Trump. So it is, if you needed any more evidence that it is a changed race, that kind of does it. Now we need to see what happens. There's still 95 plus days to the election, but it's obviously an exciting start, I think, for Harris and her supporters.
So what's going on with Josh Shapiro? Danny saw this line. It's in the New York Times. It's on CBS. Shapiro cancels his Hamptons fundraising activities. There seems to be a coalescence in the betting markets around Shapiro as being that running mate. Is he the front runner for her VP pick?
There's a lot of speculation that he is. It's really, come down to just 2 or 3 names. Pennsylvania is the biggest battleground state with 19 electoral votes. A win there for either the Trump campaign or the Harris campaign would go a long ways towards sealing an election victory. Shapiro, listen, he ran for Attorney General in 2016 and 2020. The presidential candidate for the Democrats those years, Hillary Clinton and Joe Biden. He got more votes than either of those presidential candidates in those years. That normally doesn't happen. Usually votes dwindle as you go down the ticket. It went up for him. So he's obviously drawing people from both parties, and that is one of the big attractions I think he'll have to the Harris campaign. That said, there are other people out there, but right now there's a lot of speculation that he might be in the driver's seat.
Okay, Bill, thank you very much. Bill Ferry's there on the very latest on politics. Very latest on markets from Danny and myself is, you've heard the Intel story, down 20%. But the broader markets are also under pressure today. We're going to get the jobs report. That could be fill or kill in terms of a confirmation bias on the growth scare that you've had. Equities are lower. Danny, we've had the Bank of America report, the flow show. Old school risk off is what Hartnett and the team say there. People underestimate just how much lower rates may need to go to stimulate a weak economy, no longer juiced by government spending. So if you get a rise in the jobs report, a rise in the unemployment rate, let's say, and a withering of the wages, you're going to have to see a little bit more alpha come through again from the Fed. And this is what builds the 50 basis point cut in September.
I think that's so important because you could easily form this argument that goes something like this, that 500 basis points of rate cuts didn't impact the economy on the way up. So who's to say that 300 basis points on the way down is going to be enough to save this market? Just a quick snapshot of bonds before we take you to the break. Bonds continue to rally this morning. Your 10-year yield is back under 4%, 3.9%, 4-year yield 4.1. Okay, coming up, we're going to set you up for the round out of the week. Payrolls, it's coming up in just a few hours' time.
Drum roll.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep
Great World Cup. This is a three
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Here's Bloomberg Brief. I'm Manish Krenny in New York. Let's check out what is ahead for you today. On the reporting side, big oil earnings from Exxon and Chevron report before the bell. And then it's the main event. It's the July jobs report, 8:30 Eastern time. You're looking at 175,000 and 4.1% on the unemployment numbers. Fed speak returns. Don't miss our interview with the Chicago Fed President, Austin Goolsbee. That is at 12 p.m. right here on Bloomberg Television. We've drumbeat this through the morning. Intel crashes by over 20% pre-market. Sales drop pretty much the biggest share drop in 24 years. Amazon extending its post-earnings slump, spending playbook, risks disappointing investors. And then you've got DoorDash as well, posting strong profit outlook and growth in delivery orders. Look, whatever way you cut this up, the equity markets are in a growth scare and policy error. That is the narrative that they have decided to latch onto, as well as those earnings from Intel and Amazon disappointing the tech market. You are looking at the debate now between whether this is cathartic or whether this is crisis. You will get a confirmation bias from the jobs market later on today. The Russell did choke as well, down over 3% yesterday. NASDAQ down 1.75%. The bond market is on fire. We're up for the 7th day in a row in 10-year government bond yields. So you are just seeing this market begin to price in 3 rate cuts. 10-year yields are significantly low, below the 4% level. So as I say to you, 50 basis points is now something that the market will begin to talk about, and the size and the scale of 2025 rate cuts as well. So the downside bias on the jobs report, we'll see what that number is a little bit later on today. From Dawn in New York, good morning.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, We don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
In our eyes, it all comes down to the labor market.
The markets have definitely moved from worries around inflation to worries around labor.
The labor market can turn very quickly, which is why I think Fed officials have to be cautious as they watch these data.
A strong report's probably not going to prevent them from cutting, but obviously a weak one could.
I just feel like the risks on the employment side are increasing to the point that you want to put more weight on that.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
It is Payrolls Friday, live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. We are coming into Friday, heading towards a third week of losses, and the sell-off deepens. It spreads through Asia, into Europe, and back into the United States. Equity futures, your scores look like this Friday morning. We're down by more than 1 full percentage point on the S&P 500. On the NASDAQ 100, down by 1.8%. The winner of July, the loser of August. The Russell down by 1.9%. The focus is on one thing, payrolls, the difference between the Fed having more time and running out of it. The guess this morning looks a little something like this. 175K is the estimate. That's the estimate for headline payrolls. For unemployment, it's going to be a big focus for us later this morning. We're expecting that to stick at 4.1%. We'll catch up with Kit Jukes a little bit later. The question he asked at his note over at SocGen this morning is the last 24 hours, Anne-Marie, a canary in the coal mine or a red herring?
Well, Mohamed El-Arian this morning, taking to Twitter, said it took a while, but it's now happening in a notable manner. Markets are realizing that the slowing of the U.S. economy is faster and broader than many had initially thought. The question I woke up to, Jonathan, is this a now paradigm shift in the sense that is U.S. exceptionalism starting to wane? Is U.S. exceptionalism now over?
We can get to the earnings in just a moment. I want to talk about the data of the last 24 hours before we go into payrolls. U.S. manufacturing, the ISM, contracted the most in 8 months. You look at the employment component the worst since June 2020. In addition to that, we had the highest print on jobless claims going back to August last year. Danny, we're all trying to figure out the same thing. You've been covering this with Manus through this morning. Is this another head fake, or is this the real deal?
And the thing that we're going to need to see to discern that is whether the jobs weakness we're seeing is just, still sort of this market where supply is really plentiful, immigrants are coming into the country, and that's why you're seeing some of the data, or are we seeing real layoffs? And I think that's going to be the key. That's going to be the difference when we really get worried about labor. Is the unemployment number moving up because you have companies like Intel letting go of 15,000 employees because they're facing issues now?
Check out the names in the pre-market. They're getting hammered right now. Danny mentioned Intel. Intel delivering a total dog of a quarter. Apple reporting weakness in China. Amazon's forecast disappointing. Intel's down 21%. Danny, we can sit here and say it's idiosyncratic, but I have to say I've sat here many a morning over the last few weeks and talked about things being idiosyncratic. Idiosyncratic adds up. Those job losses add up.
This is the important thing, because it's not just Intel. Again, you could say that about, McDonald's didn't do a saver menu quick enough. Delta has been mispricing their seats. The important thing is that these are missteps and they're being punished because missteps matter more when you have a weakening economy. And I think that's the distinction. Idiosyncrasies matter now because you can't just kind of paper over it because demand is strong enough to fix for those things. So the point is that these companies are making missteps, and missteps are a problem now.
And now it's hurting investors. Intel has been paying out a dividend since 1992, and now they're not going to. But I'm glad you mentioned McDonald's. This is something else Mohamed El-Erian has been talking about for years. Don't look at basically all just the hard data that's coming out. Listen to what CEOs are saying on the earnings call. What did McDonald's say this week? Is that consumers are coming in, and they are discriminating against higher prices. You're seeing the pushback when it comes to consumers. You're seeing higher credit card delinquencies, and all that pandemic savings, that's dried up.
We've seen that repeatedly, not just in McDonald's. We've seen that repeatedly over the last few weeks this earnings season. Let's get to the scores more broadly. We look a little something like this. If you're just joining us, welcome to the program. Equity futures, negative by more than 1%. The rally on 10-year treasuries continues into a 7th consecutive session. We're down by 4 basis points on 10s, a break of 4% in the last 24 hours. Your yield, 393.76. Coming up this hour, we'll catch up with Chris Verona, strategist with treasuries rallying, going into the jobs report. Bloomberg's Mandeep Singh joined us on Amazon's disappointing outlook, and Kitchik Sosokjan saying U.S. markets have been priced for policy perfection. We begin with our top story, treasuries rallying going into the jobs report, with traders boosting bets for Fed rate cuts following weak economic data. Chris Verona, strategist of Baird Company, writing the following. The question that is coming up on client calls is to what extent do lower yields suggest the bond market sees something it doesn't like? Chris, you join us now for more. Chris, good morning, sir.
Great to be here.
I want to give you some credit. This is the rally you've been on top of for quite a while. You were looking for this break lower in bond yields. Are there good reasons for it?
Yeah, listen, I think if you go back really all year, what's been the pattern on the chart? It's been lower highs in yields and lower lows. I mean, we peaked all the way back at 5% last October, almost a year ago, and every single successive rally in bond yields since then has failed at a lower high. I thought it was very notable what maybe 10, 15 days ago, we broke below that 425 level on 10s. It was a huge level, and we broke below 465 on 2s. Those were the kind of key technical dams that gave way over the last couple of weeks. But at the end of the day, the question that we're attempting to answer is, what does the bond market know here? Is it simply anticipatory of easier policy, or is it suggestive that there's some meaningful growth issue? And we'll use, I think, the equity market to help answer that question. Are we?
What do you look to?
Yeah, it's like, are we seeing the big weakness in financials? Are we seeing that? Yesterday notwithstanding, I know everything got sold yesterday, but I think it's a little early to jump to the conclusion that the bond market is dead set on some imminent recession here. And I would also just add that credit conditions have largely been pretty benign here. I know there's been some widening over the last couple of days, but you're not seeing just the complete blow up in credit that you typically would see ahead of a major problem.
Do commodities confirm or deny?
I think it depends where you look. I mean, gold's broken out to new highs this morning, roughly. I think they like lower real yields or lower nominal yields. Crude, as we know, has been weak. So at some point, you also have to start to wonder, when do lower yields and lower crude actually recatalyze some of the growth story? So there's that may be to come in the back half of the year here. Copper has certainly been weak to the extent that reflects China. But the commodity picture is very, very mixed here. I think the strongest trend, without question, remains gold.
Still, even with bonds, it's remarkable that they're still rallying this morning, because you could say we've moved from 4.7 in your 10 to under 4. We have something like 150 basis points of cuts priced in the next 12 months. We've completely obliterated that higher for longer narrative. Is this not an asymmetric risk going into this earnings report that everyone has coalesced around this really bearish story?
Yeah, I think what you've seen in the positioning is a massive shift over the last few weeks when people got caught off sides. And you can see that in the price action. You see it, I think, in the follow-through over the last several days. John and I were saying off air, what happens if you get a soft number and you actually put your low in bond yields today for the next couple months? I don't think that's out of the question. Yields are very oversold here. 375 on 10s, I think, is probably a good interim low. I think under 375 that's when you begin to say, okay, what does the bond market really know about the economy that I haven't quite figured out yet? So that would kind of be my line in the sand. Particularly the 2-year yields, they are very, very oversold here. So I wouldn't be shocked, irrespective of what the payrolls is, if we actually got a bounce in yields over the next 4, 6, 8 weeks. I think that ultimately would fail at a lower high. I think you still want to be kind of secularly more bullish bonds here, but we'll see what the next couple weeks bring.
I'm just trying to understand what the reaction to equities would be to that, because we do seem, again, I know you say it's only a few days but it does seem like a shift. That bad news is bad news, and we have a growth scare. Well, your yields go lower, and so does the price of equity markets. What tells you that that holds or not?
I mean, with 80% of stocks above the 200-day moving average, I wouldn't say this is a market that's been dying internally for the last 6, 8, 10, 12 weeks. If anything, it's actually been improving over the last 6, 8 weeks. That's not where your big problems generally come from. We're into a weaker seasonal. We're into an election season. Could you get consolidation correction? Absolutely. History tells us those tend to be modest. History tells us those tend to be modest, particularly when you enter that period in a relatively strong trend. I think we're going to change the sentiment really fast here. Whatever kind of residual bullishness was out there, I think will decay pretty quickly. So I would be careful getting too worked up about this just yet.
Not just the weakening U.S. economy, but there's also been a flight to safety because of geopolitical concerns, also falling U.S. government bond issuance. How do you discern why the market is moving?
Yeah, something we've always said in our work is you have to kind of really differentiate between what you think should happen and what will happen. And I know all year there's been all this anxiety and angst about a couple bad auctions, about this untenable debt situation that we're on. The market doesn't care right now. But those may all be things that matter at some date in the future. The market doesn't care about them.
Are you trolling Lisa while she's on vacation? Is that what you're doing?
I am trolling Lisa.
We're throwing shade at them.
Listen, I think gold has had this figured out all year, right? Gold has been the decider between what could happen and what should happen. What should happen? Should the Fed be cutting into a relatively strong economy all year? Probably not, but I think gold knew that they probably would, and gold strength has likely reflected that.
You mentioned the election. Cutting through the noise, what policies are you looking at that are going to impact the bond market in 2025, and how do you even remotely start to plan for that?
Well, I think a couple weeks ago when we were last on and we were talking about the likelihood of a Trump presidency, or what maybe seemed more likely then, would it result in kind of 2 feet off the accelerator, particularly on the fiscal side? And is that, right, maybe a month ago we were on talking about what were bond yields starting to pick up? And I think they were starting to pick up that maybe you get much less fiscal impulse in 25, and I think certainly that's been on display here. I am curious to watch how, what were described as the, quote, Trump trades over the last, 6, 7, 8 weeks, financials in particular, maybe small caps to an extent, how they behave here over the next 4, 5, 6 weeks, because there's certainly been, I think, an attitude shift towards the left in terms of a better chance of winning this election. Does the equity market actually continue to reflect that over the next 6, 8 weeks? I'm reluctant to believe any election signal in August. I think it's going to be a noisy month. Let's talk Labor Day and kind of see how these things are starting to shake out.
You were drawing a distinction between what will happen, what should happen. I want to talk about what is happening outside of the United States. Dollar yen has absolutely ripped lower.
Yeah.
We've gone from talking about the 160s to the 140s. The Nikkei 225 in the last 2 days, 2 sessions, we're down more than 8%. Yeah. We've had people come on this program repeatedly and say the Japanese equity trade is not about what's happening with the currency. We'll not be upset by what happens over at the BOJ, and then what happens? It's falling apart.
Yeah.
What do you make of the moves we've seen over the last few weeks?
My favorite part about this business is picking up little clues and then putting together some call around it. And the little clue that we began to get in April, May, June, all the Japanese exporters started to meaningfully underperform. And if yen was going to 170, that should not have happened, right? So you were seeing stocks like Toyota really weak, and we were sitting here, okay, some part of this market knows something. And this market knows yen's about to strengthen. What does that mean? We're very oversold in the short term on dollar yen, kind of in the high 140s, 150 range. Could you bounce from here? Yes. I think a bounce would fail at 153 to 155. I think you're talking about meaningfully stronger yen in the future. It's the exact opposite of what we saw in 2012 when all these Japanese exporters actually began to outperform in anticipation of a weaker yen. So there's a lot of clues coming from the equity market of where yen is heading. Now, what are the implications of that? Well, sell yen, buy tech has been the global carry for as long as many of us have been doing this. And I wonder if the kind of tech trade is reflecting that here.
Interesting. You think these two stories are connected?
Absolutely. And
is this a trend you want to step in front of?
Absolutely not. I think the change in yen has tentacles far beyond what it means just for Japanese stocks or what it means just for dollar yen cross. I think those are really important kind of pushback against this global carry.
Given what you've just said, then, you couldn't sound more bearish, because basically you just told us that we're going to get meaningful appreciation in the Japanese yen through the rest of this year. That makes it very difficult to be constructive on the rest of the market, doesn't it?
I think we're starting a process where path of least resistance for yen is stronger, not weaker. And that's a change from, obviously, where we've been for a decade. I do think in the very short term, a lot of this stuff, the rubber band's been pulled too far. 155 on dollar yen would be good resistance. I think, something like maybe 420 to 430 on 10s would be good resistance if you rallied them here. But we've started to change some really big trends.
Super smart. Chris, it's good to see you.
Thank you. Good to be here.
Thank you, sir. Thank you, and great call on the bond market over the last few months. Chris Ferrone there of Strategas, a bad company. Equity futures this morning negative across the board. On the S&P 500, we are lower by more than 1 full percentage point. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. U.S. President Joe Biden telling Israel's Prime Minister Benjamin Netanyahu it's time to agree to a ceasefire with Hamas. In a call on Thursday, Biden pledged to support Israel against Iran and Hezbollah, but the president said he was, quote, very direct with Netanyahu, saying they have the basis for a ceasefire and Netanyahu should move on it now. Venezuela opposition leader Maria Corina Machado calling for nationwide protests to defend what her party sees as its rightful electoral victory. This coming as U.S. Secretary of State Antony Blinken says the U.S. backs a transition of power. In an address to the nation, President Nicolas Maduro warned that 2 maximum security prisons would soon be ready for the thousands of Venezuelans who have protested the election results. And a joint sports streaming venture between Disney, Fox, and Warner Brothers Discovery now has a name and a price. Venue will launch in the fall and cost $42.99 per month. The platform will provide live access to major leagues, including the NFL and NBA, while including content from both ESPN and TNT. Venue will compete with ESPN Plus, which costs $10.99 a month, and the Hulu Plus Live TV package, which costs $76.99 a month. Smaller competitor Fubo filed an antitrust lawsuit back in February against the companies due to the tie-up. That's your Bloomberg brief, John.
Yahara, thank you. I cannot spend any more money on sport. I'm right here.
Well,
the limit.
Pretty sure you have Hulu, right? And this is going to be a direct competition to Hulu, so you might be covered.
Hulu, Peacock, Paramount for the Italian football.
I want to talk to whoever's naming this stuff. Venue?
Come on.
What is that?
Come on. I'm done. Up next, threading the AI needle.
If you end up actually with too little capacity, then you have service disruptions. That means companies can't scale their applications. However, if you actually deliver too much capacity, the economics are pretty woeful and you don't like the returns of the operating income.
Disappointing outlook from a couple of these big tech titans. That conversation up next, live from New York City this morning on this Payrolls Friday. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Bloomberg.com webinars.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Michael Hart at Bank of America called it classic risk-off. Hard landing risks are clearly rising at a time when consensus holds a soft landing or no landing view. South stocks, that dropping a little bit early this morning. We'll talk about that a little bit later. Equity futures, if you are just joining us going into payrolls, the sell-off continues. We're down by more than 1 full percentage point on the S&P, negative. In the bond market, the rally continues. Yields down by 4 basis points. The 10-year, a break of 4% in the last 24 hours. We're down to 393 on a US 10-year yield. Under surveillance this morning, threading the AI needle.
If you end up actually with too little capacity, then you have service disruptions, which really nobody does because it means companies can't scale their applications. So most companies deliver more capacity than they need. However, if you actually deliver too much capacity, the economics are pretty woeful and you don't like the returns of the operating income. While we're investing a significant amount in the AI space and in infrastructure, we would like to have more capacity than we already have today.
So here's the latest. Amazon falling in the pre-market, the company's outlook for operating income falling short of estimates, telling investors that profit will take a backseat to AI spending in the near term. Meanwhile, weak sales in China overshadowing a generally upbeat report for Apple, the iPhone maker expecting its new AI features to drive device upgrades in the coming months. To break it all down for us is Mandeep Singh of Bloomberg Intelligence. Mandeep, let's start with an absolute dog of a quarter for Intel. Intel just looks absolutely awful. The stock, and we don't use this word often, but I think we can say it, the stock's essentially crashing in the pre-market and early trading. Mandeep, what is going wrong at that company?
I mean, clearly they're losing their share on the data center side, and there's a reason why NVIDIA is doing so well, is because not only is it getting all the incremental CapEx spend, it's actually taking share from the likes of Intel. So that's one. The other is Intel has been investing on its foundry business for the last 3 years, and there's nothing to show over there. No revenue, and not even a ramp in terms of what they are doing on the foundry side, and that's what spooked investor because that's impacting their gross margins. I mean, now we are talking about sub 30% gross margins for Intel, which was unimaginable 5 years back, and I think that's what's going wrong with them.
Mandeep, 50% of its workforce it's letting go. Where are these jobs that they are laying off from?
I mean, look, it's across the board. I think they realize on the chip side, they don't have much exposure in terms of GPUs. So clearly there are cost cuts on that front. And the foundry business is where I think they need to make a decision, whether to divest it, whether to keep it. And if, they won't keep getting a pass because they were the recipients of, all the subsidies that the government is giving, and that hasn't helped them either. And I think the time is running out when it comes to showing execution on the foundry side.
To be fair, Intel is by far having one of the worst reactions to an earnings, but it's not just them in the chip-making world. It's ARM, it's Qualcomm falling 16 and 15% after their earnings. This is a really cyclical market, Mandeep. But can we tell where we even are in a chip market, in a chip cycle, when you have distortions coming from both COVID and now AI?
I mean, this quarter is all about AI, and that's where, you're finding out who the real AI winners are. Clearly, that's NVIDIA. AMD, everyone thinks they are getting there, but they are so far behind when it comes to showing the growth around AI relative to NVIDIA. And Qualcomm and others are the same. They don't have as much exposure as NVIDIA does, and that's where the market is really separating, who the real winners are versus who benefit, but just a tad bit.
Mandeep, bear with me. I'm just going to go through NVIDIA over the last 3 days. Yesterday, down almost 7%. Wednesday, up 13. Bear in mind, Wednesday was the biggest addition in market cap on a single stock in a single day in the history of U.S. markets. The day before that, we were down 7%. That is some real volatility on one of the biggest companies on the planet. Mandeep, what is going on with that name?
Well, look, I think everyone realizes they're going to have a great quarter. And in fact, the next 2 quarters are going to look great because the market is still undersupplied. But the market will still, the stock market will look ahead, 12 months from now, 18 months from now, what kind of quarter NVIDIA will have. And that's where, there is volatility. Will this growth continue or will it taper slightly? But there is no doubt NVIDIA is the real winner when it comes to this AI wave. Every company has increased their CapEx this quarter, barring Apple. And that just goes to show that, from the hyperscalers themselves, they're going to see 35 to 40% growth for the next 6 months.
Mandeep, can we talk about China for a moment? Just broadly, how concerned are you about what is going on in potential slowdown in China based off what we saw from Apple as well, the fact that their iPhone market is still hitting some bumps?
Look, I think there's no doubt long-term that Apple business in China, it's going to taper, it's going to decelerate, no matter how they try to, maneuver it in terms of ASPs versus making sure the Chinese government is still on their side. But longer term, it's going to go down. And Apple has done well in terms of making sure they smooth out that transition as opposed to doing it in a knee-jerk way. And credit to them, the services business grew 14%. That's what sort of insulates that steep decline in EPS or margins that everyone was hoping we don't see with Apple.
Mandeep, can I just ask, what happened to their VR headsets? It literally wasn't in the earnings anywhere, and they made such a deal over it.
Well, look, if you're not talking about AI this quarter, there's something wrong with you as a tech company. And clearly, I think they're realizing they need to make that pivot. Look at Meta. How well they had the best quality beat and raise this quarter, partly because the whole call was about infusing AI into their apps and actually benefiting from it. I think Apple has realized they need to focus more on AI, although still they are very disciplined when it comes to the CapEx side and how much they spend on AI, but clearly the narrative is shifting and it will shift more in the upcoming quarters.
Mandeep, Anne-Marie mentioned China. Do you think a strong currency is a good excuse for the weakness we saw?
Yeah, FX does have an impact, but it shifts from quarter to quarter, so I wouldn't make much out of it. In the end, it will come down to AI. That's the story. That's what everyone is focused on, and I think that's where you will see the mega caps really separate, the ones that keep growing top line and margins. Like Microsoft beat, 30% revenue growth for an $80 billion run rate business. It's so impressive. Yeah. And I think that's where you will see the separation.
Mandeep, thank you, sir. Appreciate the update. A lot to cover. Mandeep Singh there of Bloomberg Intelligence. Particularly on Apple, looking ahead to September and this upgrade cycle we've been talking about now for months and months. In fact, I would say for years. A lot of people think this step up is going to be that significant in the next 12 months that a lot of people will ultimately upgrade.
I just wonder if we're really contending with how weak the consumer is and whether they're actually willing to upgrade if it's expensive, even if it has AI.
John's my litmus test for this. He doesn't like upgrades on the iPhones, but will he upgrade for that artificial intelligence tools?
I'll let you know later this year. Kit Jukes of SocGen joins us next on a jobs report 2 hours away.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Equities look like this on the S&P 500, negative here by a little more than 1%. Some negative follow through from yesterday. We're down by 1.6% on the Nasdaq 100. The underperformance is where the outperformance has been. The Russell of small caps down by 2 full percentage points. Is this the real deal? Danny, we've had a few head fakes over the last 12 months. Jobless claims are back to where they were last August, and we played this game last summer as well. Is this a welcome cooling or an unwelcome deterioration in this labor market?
Again, I go back to the idea that it's all going to matter if this is layoffs, if that's what's forcing this move higher in unemployment, that you have these companies that are letting go of their workforce because they're realizing that just cutting costs is not going to save their margins, that they need to let people go in force. And that's when you get that nonlinear move, and that's when you say, okay, maybe 50 basis points is on the table.
The volatility in this equity market has been unreal. We closed out July with the best day of gains since February, and then we took it all back the following day as we kicked off the month of August. Switch up the board and get to the bond market. Let's sit on a 10-year yield. 7 consecutive days this 10-year has been rallying. Yields are dropping again by 4 basis points. Over this period, we've seen a drop of more than 30 basis points. Danny, that's quite a move in the last week or so.
You take it back to April, we've went from 4.7% to under 4%. You have multiple cuts priced in. You have 150 basis points of cuts over the next 12 months. How much more juice is there really left in this rally? I mean, is the risk not asymmetric? I asked this to Chris Verone, because you have this narrative building that things are really bad right now, that the jobs data is going to be horrible. 175, what we're expecting, is still fine. That is not the world falling apart. So did we overdo this bond market rally?
What's the danger zone here? What is like a really bad print? What is the bad news story later on this morning?
The thing I worry about, and Manus Cranny has been really good on this, that there's just going to be a lot of confirmation bias in these numbers. That regardless of what we get, people have decided that things are really bad, that even a slight tick lower than what we expected will be enough to continue this bond market going as it is.
There's a feeling that for a lot of people, if we get strength, we'll ignore it, that it's not real. If we get weakness, to your point, it will just confirm previous. Let's turn to the foreign exchange market. I want to sit on this. Dollar yen, the move we've seen on dollar yen from the 160s down to the 140s. We've broken below 150 in the last couple of days, 148.84. We're down another third of 1% on that currency pair. A 5th week that dollar yen has moved lower. That is the longest weekly streak of the year so far. This week, I think we're down another 3 percentage points. But it's the move of the Nikkei 225 that gets your attention as well. As this Japanese yen strengthens, this stock market is getting absolutely hammered. The Japanese equity market, Danny, down by almost 6%. We're down 8 in a couple of sessions.
And I think you've put this so well that so many people have said, look what's happening with Japanese corporates. There is a fundamental shift happening. They're getting more investor friendly. Warren Buffett is in this market. You want to be investing, and it doesn't matter what the macro is. The truth is that it does matter. You can see it in the price action over the past week that a strengthening in the yen is a problem, not to mention just the technicals of it. Japan is a much more liquid market than the rest of Asia. So if you're looking on a day like today where your entire portfolio is getting beaten down, Japan's a really easy place to sell. And I think a lot of people have overlooked the technical factors of this market.
Brutal moves. The consensus calls of the last, I don't know, 6 months or so getting unwound in a pretty vicious way over the last month or so. Under surveillance this morning, a top story for you. Shares of Amazon falling at the pre-market after warning profits will take a back seat to AI spending in the near term. Meanwhile, Apple seeing poor sales in China overshadow a generally upbeat earnings report. Nvidia is the last of the Mag 7 to report later on this month. Politico reporting the DOJ is investigating the company's acquisition of Run AI, Anne-Marie, on antitrust grounds.
And this was actually, it seems like a pretty small acquisition in terms of NVIDIA, I think $700 million. What it feels like is like potentially you have the DOJ starting to look at these AI leaders because they don't want them to become the social media or e-commerce behemoths that we already have in the United States. So they're getting in ahead of it and potentially some concerns they have. Also, shaping a lot of this when it comes to safety, national security concerns. So I think you're going to start to see a lot more of these crackdowns coming from Washington when it comes to these AI players.
We're seeing this massive spend on AI, and Mandeep Singh of Bloomberg Intelligence was with us about 10 minutes or so ago. And what did he say? NVIDIA wins, Intel loses. That's the story of this quarter.
Well, the great thing for NVIDIA is that all of the hyperscalers we've heard of, despite the market not liking what they've heard, they've all talked about this huge spend they're going to do this year. I think Amazon yesterday was something like over $60 billion for the year. If you look at where NVIDIA gets its revenue from, it is Meta, it is Amazon, it is Microsoft. Microsoft is 20% of its revenue. So you could say, yeah, the market really didn't like these earnings, but these companies are spending, and ultimately, who does that benefit? It's NVIDIA.
That's the earnings story. Let's just take a beat and pause. Just fantastic scenes on American soil in the last 12 hours or so. President Biden and Vice President Kamala Harris welcoming home Wall Street Journal reporter Evan Gershkovich and other Americans freed in the largest prisoner swap with Russia since the Cold War. The swap including 16 people going to the West and 8 returning to Russia. Just beautiful scenes on this side of the world.
Absolutely amazing. And our photographer that was there on the ground actually has this pretty incredible photo of Evan Gershkovich lifting up his mother, just pure joy. And you can actually listen to the conversation President Biden had with all their families around them, phoning into the airplane as they were in Turkey, coming over to the United States. Really incredible moment. Obviously, though, I think in the next few weeks, after people start to recalibrate, what does this actually mean? The U.S. got back civilians, and they traded for assassins and criminals, basically.
This was a prisoner that was swapped in Germany that the German government did not want to give up. Someone who assassinated someone in broad daylight just for, again, normal journalists. I have to say the Wall Street Journal has such a good piece on this. It's something they've been working for years, essentially, since Evan was first jailed. It ends with saying there's basically this pro forma form that you need to send to Putin when you're being released to say, you know, please release me. People usually don't really fill it out. He filled it out, and at the end of it, asked for an interview.
I can't wait to read his book. And I hope it includes a sit down with Putin somewhere not in Russia, maybe when he goes on one of these overseas trips.
Yeah, I'm not sure he'd want to do that again. Just unbelievable. Fantastic scenes here in America in the last day or so. Let's turn to the economic data. The US jobs report just under 2 hours away. The median estimate in our survey looking for a print of 175K. Kit Jukes of SocGen warning the jobs data have more potential to move markets than usual, writing this. The US manufacturing sector has been losing momentum and employment growth has been slowing for months. The question is whether we are near a tipping point where the pace of slowdown picks up enough to make the Fed wish it had started to cut rates sooner than it has. Kit joins us now for more. Kit, it's great to catch up with you, sir. I just read the first line, if you noticed, as soon as it dropped earlier this morning. Canary in the coal mine or a red herring? Kit, which one is it?
We won't know till September or October. We're at that time of the year where if you think, you know, new people leave school, they look for jobs, companies look ahead at next year and make their plans. And if they feel nervous about next year, they hire fewer people or they lay people off because they don't need them, start making those kind of announcements. When people come back from vacation, they decide whether they're being really cautious with money or whether they fancy going out and spending more. And, you know, it always feels to me, it's one of the reasons August is a fascinating month and a terrifying month, illiquid and a great guide to where we're going next. I think we'll know more by then. So far, you've got to say the unemployment rate is super low. The employment rate is super high. The economy is not weak. It's just losing a bit of momentum. To the earlier question, I think we need to look at the private payrolls number because we should ignore what's happening a little bit on the public sector. That was just under 140,000 last month, 136,000. That comes in under 100. I think there'll be some fireworks in markets this afternoon. That's probably the place to watch. But this has been an extraordinary cycle. It feels tired to me, but hey, I'd have said the same thing last year. You know, it's been so resilient. So I'll watch the numbers for this month and next month.
Yeah.
And then we'll know.
Kit, does it feel tired because we're tired of it? Or are you looking at the economic data and it signals that this cycle is ultimately tired? Because we've had growth scares like this before. We've had head fakes, particularly in jobless claims. Had one last summer. What's the difference between, say, last August when jobless claims were at these levels and what we're seeing right now?
I think there's certainly less spare post-COVID money floating around for a large hunk of the American population. There's less external drivers of strength. There's nothing that sits there and says it's going to make things accelerate. Other parts of the world are more clearly slowing. So there's a lack of things you can put your finger on that says, yeah, this could be okay. And I think that's probably the single biggest piece. But I'm with you. It said this mad cycle has, you would never have guessed we'd have got this far from 2020 without having had a proper recession. I mean, it's just like, how did we manage to keep this plane in the air, in the sky for so long? Yeah, it'd be nice if it keeps on happening. I think it gets tougher each mini cycle to do that.
And Kit, that is what has had people thinking that there's going to be a recession for over the past year plus. But this has been a really good year to fade all of those impulses, to fade six cuts priced in at the start of the year, and then on the other side, to fade no cuts priced in. At the moment, for the next meeting, for September, 33 basis points of cuts are priced in, which does imply that we have about even odds for a 50 basis point cut, when we just heard from Powell on Wednesday, who was cool, calm, and collected. Are we not getting ahead of ourselves?
Yes, in a sense, we always are. In other words, do I think we're ahead of ourselves on rate cuts? Something dramatic has to happen for us to get a 50 basis point cut next month. And I mean dramatic. At the moment, this is an economy that's, I don't know what it's doing. It's driving along at 55 miles an hour. It's doing perfectly all right. You just worry about it, that it's unlikely to be able to accelerate. It's more likely to slow down. But fading recessions is always the right call until the day they start to happen. I think we'll learn a lot this summer. I'll be fascinated to see if this number comes out, because what we do know is that when momentum slows, it slows quite quickly in most cycles. But right now, if you looked at the state of the U.S. economy, all you can say is inflation's coming under control, the Fed's going to cut rates, and the economy is not weak. It's just trundling along just fine and better than anybody would have thought 18 months ago.
Kit, when you say dramatic, what would that mean in today's payrolls report? What's a dramatic number?
Sub 100 on private sector payrolls. So they were 136 last time. So that puts it in context. If you come in with a number at 120 on overall payrolls, I mean, I think I'm going to try to phase out the public sector employment piece just to keep on going. But you get under 100 on the private sector, you start saying, okay, that's more of a problem. But it has to be something at least like that. Otherwise, this is summer noise and we might just overreact to it because we're in August.
Okay, I just want to jump back to dollar yen just quickly. I think we always want that fat directional move in the FX market, and we had it one way on dollar yen, and we're looking to add to it going the other way. Is this move exhausted? How do you sort of gauge how far this one's gone and whether it's running out of steam?
If the Fed gets rates most of the way back to where they were before we started in 2020, we'll get back to 100. But you cannot go at this speed because it's the rate of change, it's the change in the value of a currency that affects inflation and affects businesses. So this is hurting the equity market because it's having a really aggressive impact on profitability and on what people do. So we have to pause. We have to pause, perhaps bounce. We can't keep on going at this pace for much longer. If the Fed's cutting, I don't think we can be above 140 next year. If they're cutting a long way because there's a serious slowdown, then yeah, we can go back to 120 and see where we go from there. So there's a long way to go for, but this is very much a function of where U.S. interest rates are, right? This was possibly the biggest carry trade that we've ever seen because the Japanese kept still while the Fed hiked and hiked and hiked and hiked, and everybody else did in the rest of the world. And now if everybody else goes all the way back, we will go a long way. But the appreciation hurts profits, cuts inflation, and so the rate of change is massively important. We need to pause. I'm not sure if we can pause much in the middle of August, for what it's worth.
We'll see what happens over the next month. Kit, appreciate it, sir. Kit Jukes there of SocGen. We have to pause again, and we have to pause to read through one quote from one op-ed from one Wall Street giant in the Washington Post this morning. Jamie Dimon of JP Morgan. Now, people often say, why do we always talk about Jamie Dimon and the prospect of Jamie Dimon going into government? Well, Jamie Dimon himself sort of encouraging that conversation this morning. Check out this quote. The private sector has huge wells of expertise and produces 85% of our nation's jobs. It should have a seat at the table. Yet in recent years, government leaders have often failed to engage those in industry. Anne Maria President should put the most talented people, including those from business and the opposite party, into their cabinet.
This is the most blatant ask to be a part of administration I think I've really ever seen. What is so interesting as well is it's almost like Professor Jamie Dimon. He's talking about the U.S. as an inflection point. He's going back in history, but he keeps saying the next U.S. president, the next U.S. president. Well, whose team are you on? Is it the next U.S. president, Donald Trump, or the next U.S. president, Kamala Harris? What remains to be seen, we don't know who he's pushing for, but what's obvious is that he wants a seat at the table, regardless of who's in the White House.
Well, I wonder if some of the points he's making exclude him from one ticket, because he talks about the need to support our allies, to have diplomacy, trade, and the active promotion of democratic values. I don't know, that seems like one administration would not necessarily want to go that way.
It's quite a column, and I suggest everyone will have a read of that here on Wall Street throughout this morning, including JP Morgan employees. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Chevron missing second quarter earnings expectations, putting renewed pressure on CEO Mike Wirth as he pursues a $53 billion takeover of Hess. The takeover was agreed to nearly 10 months ago, but has been delayed by an arbitration case brought by arch-rival Exxon, which claims to have right of first refusal over Hess's stake in a Guyanese oil development. Chevron also saying it will relocate its headquarters from San Ramon, California, to Houston, Texas, with full migration of operations completed over the next 5 years. Chevron shares are falling down more than 2% in the pre-market. Meanwhile, Intel shares are plunging in the pre-market after the chipmaker forecast revenue for the third quarter that missed analyst estimates, along with making a string of disappointing announcements. The company said it would suspend its dividends starting in the fourth quarter, and it will begin slashing 15,000 jobs. And Andy Murray ended his tennis career with a quarterfinals defeat in men's doubles at the Olympics. The multiple Grand Slammer jokingly posted on X that he, quote, never even liked tennis anyway. Murray had said this summer's Olympic Games would be his last event. Over the course of his career, Murray won 2 Olympic gold medals, one in London's 2012 Games and the other in Rio de Janeiro in 2016. He won the U.S. Open once and Wimbledon twice, his first win at the All England Club, making him the first British man to win that trophy in 77 years. What a run. That's your Bloomberg Brief. John?
Yahara, thank you. I'm not sure what it is about this Olympics and making me cry. What is it about?
Same.
Last couple of days.
I credit Simone Biles and I credit Andy Murray too. Not him necessarily losing, but the reception he got afterwards. Everyone gave him a standing ovation. The Americans were clapping for him. It's just really tugging on the heartstrings.
Super emotional. A lot of people cried about the opening ceremony too, but for very different reasons. It's a very different kind of crying. Up next on the program, all eyes on the labor market.
The labor market is not necessarily on the precipice of breaking. We've seen non-farm payrolls, yes, with increased volatility, but an average pace of over 200,000 thus far for 2024. That's still indicative of a relatively solid labor market.
That conversation up next, live from New York. You're watching Bloomberg TV.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Payrolls 1 hour and about 41 minutes away. The number we're looking for, the estimate on the headline print, 175. That's the estimate in our survey. Going into it, the scores look like this. We're down another 1 percentage point on the S&P 500. Bonds are still rallying. Yields are lower by 3 or 4 basis points. We rallied for a 7th consecutive session. The 10-year, 393.95. Under surveillance this morning, all eyes on the labor market.
The labor market is not necessarily on the precipice of breaking. We have seen a loss of momentum. We've seen non-farm payrolls, yes, with increased volatility, but an average pace of over 200,000 thus far for 2024. That's still indicative of a relatively solid labor market.
So here's the latest, counting down to the July jobs report due at 8:30 Eastern. The median estimate in our survey calling for 175K. Sarah House of Wells Fargo has this to say. We've revised down our call for payrolls to 165. Our previous call was 180. We're incorporating the jobs market data of the last few days. Sarah joins us now for more. Sarah, that's a good place to start. The data of the last few days. What was it about that that was a little bit jarring for you, jarring enough to bring down your forecast?
Yeah, it was really a confluence of the data this week. So it started with the last of the Fed services PMIs, which showed that on average, you saw hiring in the service sector, the index declined about 2.5 points. We saw downward trend in job openings, but really the gross hiring rate back to 2014. You look through later in the week, upward drift in jobless claims, and I really think the cherry on top was that ISM manufacturing and employment print, which I think together points to that the trend in hiring really has downshifted over the past month.
Sarah, what number today, if any, could mean the Fed will cut 50 basis points?
Yeah, so I think it would have to be pretty low. I think certainly below 100,000, maybe even closer to negative. I think it's also going to be important in terms of what was driving that. So to what extent do we see some potential effects from Hurricane Beryl hitting during the survey week? And so I think we'll have to try and strip out part of that. But I think it would take a pretty weak number to at least get the Fed to move 50 basis points at its next meeting, given that you still have some hawks that I think are concerned about the overall inflation backdrop still and making sure that they don't want to ease up too soon and they're okay with a little pain in the labor market.
But for those that are the doves, you get this sense that they worry that the Fed's behind the curve and they'll need to cut a lot in order to catch up with where the labor market is going. Michael Hartnett of Bank of America hits on this, that people underestimate how much lower rates need to go to stimulate a weak economy. Sarah, if some 500 basis points of hikes on the way up didn't act that quickly to bring inflation in, what's to say what's needed on the downside to make sure this labor market doesn't deteriorate further?
Well, I think that the Fed will, they do have a lot of ammunition, I think to stimulate the economy. And in many ways, there were so many unique circumstances around this pandemic that I think kept growth strong and made it take a while for inflation to come down. So, of course, the supply shortages impacting inflation, but also as they recovered, helping the growth picture as well. But I think as we get back to a more normal environment, that you could see the the impact of rate cuts, I think maybe taking on a more traditional role. But I think ultimately the Fed needs to get going soon, just given that we have seen, I think, some market deterioration in the jobs market the past year.
If the Fed needs to get going soon, you think we've already seen the market deterioration. Do you think they've already made a mistake?
So I think it's still a little bit too early to tell, but I think, again, given that you have seen some pretty unique circumstances, and it is hard to parse out just how much of the slowdown over the past year has been this idea of normalization versus outright deterioration. So I think right now it's still more a matter of normalization, but given that negative momentum that we continue to see in the jobs market, something has to change to arrest that, and I think that change is a policy change here soon.
Sarah, I just got a message from a Bloomberg Terminal subscriber. They'd like us to ask you about Hurricane Beryl and the kind of impact we might see in this particular jobs print. How are you framing that? What kind of number will that subtract by from the overall number?
Yeah, so I think it'll have at least some impact, not looking for a huge impact. So if you look, for example, back when you had Hurricane Harvey and Hurricane Irma hitting in 2017, you actually saw a negative payroll print initially. But those were much larger storms, I think, that you saw impacting across the entire survey period. So the hurricane hit in the second week of the month. And so potentially you could see workers who are maybe out following the hurricane were still on the payrolls during the first part. So we're not looking for as big of impact, given that some workers are still going to get paid even in the impacted area.
Got it. Sarah, thank you. Sarah House there of Wells Fargo looking for 165 at 8:30 Eastern. That was down from 180, their previous estimate. The consensus call, the median estimate in our survey is 175. Is the mistake trade already building in the last 24 hours? At 8:31, and I said this on Wednesday after the Fed decision, at 8:31, we're going to have a very different conversation. Either it's going to be one, yes, growth scare, mistake trade on, or the other, things settle down and we all get a nice weekend.
And so much of that just might hinge on what the unemployment number is, just because of this hyper focus on it. I know 4.28% is what triggers the SOM roll. You can argue whether it's important or not, but just so much has been baked into this, so much anticipation of a slowdown. If you get a whiff of that, if you get even close to that, you have the feeling that this is a bond market that's ready to run away with it, and an equity market that's changed to bad news is bad news and will sell off alongside it.
Well, I think that's what Sarah's waiting for, to find out exactly what that unemployment rate might be. Does that mean outright deterioration versus what many